Good morning, everybody. Yes. So yesterday we started with TCS. TCS we have completed section 206C, subsection 1. Section 206C, subsection 1 is over. Section 206C, subsection 1C is over. Section 206C, subsection 1S is over. Three sections are over. Now we need to move on to budget 2020 amendment section. These both sections were introduced in budget 2020. Section 206C, subsection 1G, applicable with effect from 1st October 20. This is having 2 points. Section 206C, subsection 1G is having how many points? It is having 2 points. Number 1, TCS and overseas remittance. Overseas remittance means when you transfer money outside India. So when you transfer money outside India, definitely government would like to know what is the source of your money. The money which you are sending outside India, is it your white money, black money, what it is? Or you might be having huge amount of black money. You can open a new bank account and you can transfer money outside India. Therefore, government wants to monitor as to the amount which you are sending outside India. Who are you? Who are you? To whom you are sending money? How much money you are sending? Why you are sending money? All these things government wants to investigate. Therefore, government has come out with a provision. Are you getting my voice clearly? Okay. So I was telling you that government wants to investigate who is sending money outside India, to whom it is he is sending money outside India, for what purpose he is sending money outside India. So when you are sending money outside India, government wants to monitor all those things, and government wants to check whether you are when you are sending money outside India, government wants to monitor and track those transactions. Therefore, government says we will collect the TCS. TCS will be collected when you send money outside India. Once the TCS is collected, your details will be there with the government of India. So if they want to investigate something, they can easily investigate. You will be within the reach of the government. So TCS on overseas remittance. TCS on what? Overseas remittance and sale of overseas tour package. See, nowadays, if you see, since last 5-10 years, the most dangerous trend has started in India is people go for their vacation, people go outside India. For family vacations, people are going outside India. In fact, India is the world's best tourist destination. There cannot be a better tourist destination, spiritual tourist destination than India. In the entire country, there cannot be a, in the entire world, there cannot be a better country than India to visit for a spiritual destination. Besides that, forget about spiritual tourism. Normal tourism also, India is having excellent places to visit. But a trend has been started in India. Indian people are going outside India for their personal tours, for their family vacations. So government wants to track those people, and government wants to find out as to those people who are going outside India for their family vacations, whether they are having that much amount of income also or not. See, nowadays, if you see, people will go outside India for family vacations. They'll take the photos and they'll upload the photos on the Facebook, social networking sites, etc. So government wants to track whether they are having that much amount of income or not. That is what government wants to see. Therefore, government has come out with a TCS in case of a overseas tour package also. So there are two things. Number one, TCS on overseas remittance of money, and number two, TCS on sale of overseas tour package. If you remit money outside India, definitely you will remit money outside India through some dealer, etc. So that dealer or maybe bank or maybe post office. So the person through whom you are sending money outside India, that person has to collect the TCS. And here, when you are going outside India, you might have booked a overseas tour package. So the tours and travels agent through whom you have booked the overseas tour package, he will collect TCS from you. So point number A says authorized dealer receiving money for remittance outside India under a liberalized remittance scheme of RBI shall collect TCS at the rate of 5%. Liberalized remittance scheme is not defined anywhere in the Income Tax Act. This I have taken from RBI website. Liberalized remittance scheme means it will facilitate resident individual to freely remit funds up to $250,000 outside India in a financial year for any permissible capital or current transaction or combination of both. Means question will not be asked. If you are sending money outside India up to 2.5 lakh US dollars, then we will not question it. We'll transfer the fund without questioning. So an authorized dealer is receiving money from you for remittance outside India under a liberalized remittance scheme of RBI. He shall collect 5% TCS. If you do not submit PAN number, Aadhaar number, then he shall collect 10% TCS. Very important point to be noted, no TCS should be collected if the amount remitted is less than equal to 7 lakh Indian rupees. Amount remitted outside India is less than equal to 7 lakh Indian rupees. TCS at the rate of 5%, the amount remitted in excess of 7 lakh. For example, you are remitting 10 lakhs outside India. Then TCS will not be collected on entire 10 lakhs. It will be collected only on 3 lakhs. So up to 7 lakh, no TCS. TCS will be applicable only beyond 7 lakhs. TCS at the rate of 0.5% will be applicable instead of 5%. What is the normal rate of TCS here? 5%. If you don't submit the PAN number, don't submit the Aadhaar number, then 10%. But say for example, your child has gone outside India for education, and for his education you have taken a loan. That money you are transferring outside India so that you can pay the fees of the educational institution. In that case, TCS will be levied at the rate of only 0.5%. So TCS at the rate of 0.5% on amount exceeding 7 lakhs in case of education loan remitted outside India. If it is the case of education loan remitted outside India, then TCS at the rate of 0.5% will be collected on amount exceeding 7 lakhs. So if you have taken an education loan and that funds you are transferring outside India because you are taking education outside India, you have to pay fees outside India to education institution. For that you have taken an education loan. On that only 0.5% TCS will be levied. Only 0.5% TCS will be levied. Is that very, very clear? Yes, okay. Point B is overseas tour package. I told you now. This point section 206C subsection 1G is divided in two parts. Number one, TCS on overseas remittance and TCS on sale of overseas tour package. So first point A is over. TCS on overseas remittance. This is over. Now we move on to TCS on sale of overseas tour package. Seller of an overseas tour program or package shall collect TCS at 5%. In case of non-PAN, non-Aadhaar transaction, it should collect TCS at 10%. When to collect TCS? TCS should be collected at the time of debiting the account of buyer or at the time of actual receipt of money, whichever is earlier. No double collection means on the same amount, TCS will not be collected in two different sections. TCS cannot be collected in two different sections on the same amount. Section 206C subsection 1G says this section will not apply. This point is saying that this section 206C subsection 1G means this section will not apply where TDS provisions are applicable. If anyway TDS provisions are applicable, then we will not apply the TCS provision. On the same transaction, we cannot apply the TDS as well as TDS as well as TCS provisions. So, if the buyer has deducted TDS, then section 206C subsection 1G will not apply. If the buyer has deducted TDS, then the seller should not collect the TCS. Say for example, buyer is a company and that company is taking all its employees outside India for a overseas tour. First situation means this section only, na? Dikshit. In this section, TCS will be collected at the time of debiting the account of the buyer or at the time of actual receipt, whichever is earlier. See, this point number 2, 3, 4 is common for both the situations. Point number 1 was divided in two parts. Part A, overseas remittance, and part B, overseas tour package. Point number 1 was divided in two parts. Point number 2, 3, 4, 5, they are common for both. No double collection. TCS cannot be collected twice. Section 206C subsection 1G shall not apply if the buyer has deducted TDS. Say for example, a company has booked the overseas tour package for each and every employee, and that company is taking all employees outside India for a overseas tour. While paying money to that overseas tour operator, company will definitely deduct the TDS. Company will deduct TDS under section 194C. If TDS is already deducted in the TDS provision, then TCS provision will not apply. If the buyer is a notified person, then no TCS. What do you mean by notified person? Notified person means central government, state government, embassy, high commission, legation, commission, consulate, trade representation of foreign state, local authority, or any other person notified by the central government. From these people, you should not collect any TCS. Authorized dealer and overseas tour program package is defined here. There is no need to remember these things for you, but to just read it once. In fact, there is no point of reading also. Have you understood this? Section 206C subsection 1G. Yes. Okay. Let us proceed. Section 206C subsection 1H. Section 206C subsection 1H. This section is introduced and this section is having a far-reaching impact. It is covering every sale transaction. In the TDS provisions, while explaining section 194C, I had explained you that section 194C is applicable only in case of works contract, not sale contract. Now this section is introduced by the government in the current year and is having far-reaching impact because this is applicable in case of each and every sale transaction. Definitely exceeding a particular limit, but most of the sale transactions are covered if they are exceeding a particular limit. With effect from 1st October 20, TCS and sale of goods above the specified limit. So whenever goods are sold above the specified limit, TCS is required to be deducted. So here there are two persons, seller and buyer. Here there are two persons, seller and buyer. Seller of any goods has to collect TCS at the rate of 0.1% of sale consideration on amount exceeding 50 lakhs. If the seller is selling goods to the buyer and the transaction value is more than 50 lakh rupees, then he should collect TCS at the rate of 0.01%. COVID special rate is 0.075%. See, 206 is subsection 1G. There was no COVID special rate. Here there is a COVID special rate. Instead of 1%, it is 0.075%. If the goods are sold between the period 14th May 20 to 30th March 21. The provision says every person being a seller who receives any amount as consideration for sale of any goods of the value or aggregate value exceeding 50 lakhs in a previous year, other than being goods exported outside India, why no COVID rate in this case? Na? Maybe, see, in this COVID environment, who will go outside India? In this COVID environment, who will go outside India? Do you believe someone will go outside India in this COVID environment? And if at all he goes outside India, is having so much amount of money, then why should not we collect TCS at a higher rate? And TCS is not tax. It is just a tax collected only for the purpose of tracing. This tax is not collected based on your income. These taxes are collected only to trace the transaction, only to trace the person who has entered into the transaction, so that you can ask the questions to the person. The way you get TDS credit, similarly, we'll also provide you TCS credit. So collecting this TCS is just a formality. So this point says every person being a seller who receives any amount as a consideration for sale of any goods of the value or aggregate of such value exceeding 50 lakhs in the previous year, other than the goods exported outside India or goods covered in section 206C subsection 1 and subsection 1F or subsection 1G. See, wherever section 206C subsection 1 is applicable, section 206C subsection 1F is applicable, section 206C subsection 1G is applicable. In those situations, subsection 1H will not apply. Two sections cannot be applied in the same situation. So when other sections are applicable, this section will not apply. It is implied because specific provision will prevail over the general provision. If the PAN number is not submitted, Aadhaar number is not submitted, then TCS will be collected at higher of twice the rate given in the subsection or 1%. The rate given in this subsection is 0.1%. Twice the rate is 0.2%. Compared to 1%, whichever is higher, 1% TCS will be collected. Section 206C subsection 1 do not apply if the buyer has deducted the TDS. If buyer has deducted TDS, then seller will not collect the TCS. Meaning of buyer, for the purpose of section 206C subsection 1H, buyer means a person who purchases any goods. Buyer means a person who purchases any goods, but it will not include central government, state government, embassy, High Commission, Legation, Commission, Consulate, same thing is written. Trade representation of foreign state, local authority. This one point is extra, point number 3. A person importing goods into India or any other person is the central government may notify by issuing a notification in the official gazette. So from these people, you should not collect any TCS in section 206 subsection 1. Meaning of seller. Seller means a person whose turnover, sales, gross receipt from the business exceeds 10 crore rupees in the immediately preceding financial year. It exceeds 10 crore rupees in the immediately preceding financial year. Is that very, very clear? Yes? Okay. Next is section 206 subsection 1I. It says CBDT may issue guidelines for implementing section 206 subsection 1G and 1H. These two sections which are made by the government and implemented with effect from 1st October 20. Now, for implementing these sections, if there is some difficulty, then for that CBDT may issue certain guidelines or clarification. These guidelines should be laid before the parliament before they are issued. Before these guidelines are issued, they should be laid before each house of parliament. That is Lok Sabha as well as Rajya Sabha. So with this, we have completed TCS provision. Now listen to me very carefully. See, while we discuss the TDS provisions, I told you that there are 4 duties of payer and two duties of payee. Which are the 4 duties of payer? Number 1, deduct tax. Number 2, pay tax. Number 3, file the TDS return. And number 4, issue the TDS certificate. Issue the TDS certificate to the payee. What are the 2 duties of payee? Even though he has received the net amount, he should consider the gross amount while computing his total income. Even though he has received the net amount, he should consider the gross amount while computing total income. And number 2, from his total tax liability, he should claim the TDS credit. That is what is written in section 198 and 199. Similarly, here there are 2 persons, collector, collectee. Collector means a person who is collecting the tax. In most of the transaction, he is a seller. Collectee is a person whose tax is getting collected. In most of the transaction, he is a buyer. So here, we say that there are 2 persons, collector and collectee. Person who is collecting tax is called as collector, and person whose tax is getting collected will be called as collectee. Now the point is, what are the duties of collector and collectee? First duty of collector is to collect the tax. Then he has to pay this tax to the government. Then he has to file the TCS return. And then he has to issue the TCS certificate to the collectee. And what collectee will do? Collectee will claim the TCS credit. The way payee will claim the TDS credit, your collectee will claim the TCS credit. So these are the due dates for payment of TCS to the government. If you recollect, for TDS also we had some dates, na? So here also we are having some dates. I will refer this. You should identify and tell me what is the difference. You should identify and tell me what is the difference. Time limit for paying tax collected to the credit of central government. If the collector is office of government and if the payment is made without challan, then TCS should be paid on the same day. If the payment is accompanied by challan, then this TCS should be paid to the credit of government on or before 7 days from the end of the month in which collection is made. The month in which collection is made, from the end of that month, by 7th of next month. By 7th of next month, you have to pay TCS to the government. Second is collectors other than the office of government. Collectors, other than the office of government, within 1 week from the last day of the month in which collection is made. Within 1 week from the last day of the month in which collection is made. Meaning thereby 7th of next month. Meaning is nothing but 7th of next month only. Can you tell me what is the difference between TDS payments and TCS payment due date? In case of TDS for the month of March, TDS was required to be paid by 30th April next year. Yes or no? But here for the month of March also you have to make payment by 7th of April. Yes, everything else is same. Everything else is same. In case of TDS, for the month of March, TDS was required to be paid to the government by 30th of April. So some lengthier span of time was given, relaxation was given. But there is no relaxation here. Here, for the month of March also, you have to make the payment of TCS to the government by 7th of April. So this is the difference. Next, consequences of failure to collect or deposit tax. Consequences of failure to collect or deposit tax. Do you recollect 4 consequences of failure to deduct tax or failure to pay tax? Number 1 consequence. What was the number 1 consequence? Yes, deduction for the expenditure will be disallowed to the payer. Number 2, payer will be called as assessee in default. Penalty will be levied. Simple interest will be levied at the rate of 1% per month or part of the month for delay in deducting TDS. Simple interest at the rate of 1.5% per month or part of the month will be levied for delay in payment of TDS. So payer had to face 4 consequences for defaulting, deducting or paying tax. Similarly, here there are consequences. Consequences of failure to collect or deposit tax. The collector has to pay simple interest at the rate of 1% per month or part of the month. Collector has to pay simple interest at the rate of 1% per month or part of the month. From which date to which date? From the date on which tax was collectible till the date on which tax is actually deposited to the credit of government. From the date on which tax was collectible till the date on which tax is actually credited to the government account. You have to pay interest at 1% per month or part of the month. On what amount? Definitely on the amount of TCS. Section 206C subsection C says such person shall be deemed to be an assessee in default. Yes, definitely on TCS amount. Because only that TCS amount belongs to the government now. So interest will be levied only on TCS amount. That is implied. Here the collector will be considered as assessee in default. However, collector will not be considered as assessee in default if 4 conditions are fulfilled. Do you remember similar provision was there in TDS also? Payer will not be considered as assessee in default. Payer will not be considered as assessee in default. Yes. So, Deva madam, not to include TDS in income. Whatever income is received now without deducting TDS, that entire income should be included in the taxable income. We are not talking only about the TDS amount to be included in the income. We are talking about the entire income to be added in total income. So in TDS, we have discussed that payer will not be considered as assessee in default if he gets 3 jobs done from the payee and he submits the certificate from a chartered accountant to this effect. Number 1, payee has considered this income Payee has considered this income in his total income. On whatever amount TDS was not deducted now, on that amount payee has considered in his total income. Payee has paid the tax on his total income. He has filed the TDS return. He has filed his income tax return within the due date. If all these three jobs are done by the payee and payer gives a certificate to this effect, he takes a certificate from a chart accountant and submits to the income tax department. In that case, payer will not be considered as assessing default. Same provisions are there for TCS also. Well, here we are saying that payer will not be payer responsible for collecting tax. Payer responsible for collecting tax will not be considered as instead of payer, we should use the word collector. Collector responsible for collecting tax will not be considered as assessee in default, provided the collectee, provided the buyer, provided the licensee. He has furnished his return of income under section 130 and subsection 1, that is within the due date. He has taken into account such income in such return of income. See, actually government has just copied the provision without applying the mind. For buyer, it is not an income. Buyer is purchasing goods. For him, it is an expense. So in fact, government should have slightly modified this point, saying that buyer might have taken into account that transaction while computing his income. Instead, they have told taken into account such income. It is not an income for the buyer. For buyer, it is an expenditure. Anyway, so they have not applied their mind, just copied the provision. The buyer has taken into account such income in his return of income. He has paid the tax due on the income declared by him in return of income, and the seller, that is a collector, furnishes a certificate to this effect from a chart accountant in prescribed form. However, this relief is not available in respect of section 206C subsection 1F. What is section 206C subsection 1F? Sale of motor vehicle exceeding 10 lakh rupees. So, in case the dealer has failed to collect tax, in case he is selling the motor vehicle and dealer has failed to collect tax, then what will happen? Then dealer will be considered as assessee in default. Even though these three jobs are done by the buyer, dealer will still be considered as assessee in default. He has to face the penalty. Proviso to section 206C subsection 3, filing of quarterly TCS statement. The way you used to file the TDS return, similarly here you have to file the TCS return. This TCS return also is required to be filed on a quarterly basis. For the first quarter, it is required to be filed by 15th of July. For the second quarter by 15th of October. For third quarter by 15th of January, and for fourth quarter by 15th of May next year. No, Sarvana. Buyer has to consider that as expense only. He cannot consider it as income. No, it is not possible. It is a drafting error from the side of the government. That's what I told you. Government has not applied the mind. They have just copied the provision from TDS. Government should have applied the mind, but they have failed to apply their mind. They have just copied the provision from TDS. Therefore, the language is same. Now, do you understand this? These are the due dates for filing the TCS return. What were the due dates for filing the TDS return? Due date for filing TDS return for the first quarter 30th June by 31st July. For the second quarter, that is 30th September by 31st October. For third quarter, that is 31st December by 31st January. and for the fourth quarter, that is ending on 31st March, by 31st May. So it is next month's last date. Once the quarter is over, the month succeeding the quarter, na, last date of that month. But in case of TCS, that is not the case. In case of TCS, only 15 days time is allowed. So instead of 31st July, here it is 15th July. Instead of 31st October, it is 15th October. Instead of 31st March, it is 15th March. Instead of 31st May, it is 15th May. Is that very clear? Fees or penalty for defaulting furnishing TCS return. Same section, section 232E. Fees will be 200 rupees per day, but the amount of fees should not exceed the amount of TCS. And the last point, application for low TCS certificate. Application for low TCS certificate. In TDS, we had application for low TDS certificate. Here we are having application for low TCS certificate. SSC can apply to the income tax officer. Rizwan, if the collector has failed to collect the tax, not deduct the tax, collect the tax, then interest is payable at the rate of 1% per month or part of the month. From which date to which date? From the date on which tax was collectible till the date on which amount is deposited to the credit of central government. So in TDS, that interest was divided in two parts, na? 1%, 1.5%. Yes or no? Here it is not separately. Here it is only single rate 1%. Here it is only single rate 1%. So in TDS, we also had application for low TDS certificate or no TDS certificate. Similar to that, we also have here application for low TCS certificate or no TCS certificate. Such application will not be entertained if the PAN number is not given along with the application. So our TCS provisions are also over. This chapter was divided into three parts: TDS, TCS, and advanced tax. So we have covered TDS, we have covered TCS. Now we are left with third part, that is advanced tax. So now in this chapter, basically two parts are pending. Number one, advanced tax, and number two, interest under section 234 A, B, and C. And we have one practical question, question number 10 on interest under section 234 A, B, and C. There are three different mechanisms for collecting the tax. By all these three different mechanisms, government will collect the tax from the taxpayer. All these mechanisms are applicable in different situations. Number one, TDS mechanism is applicable when the person is paying income to someone. TCS mechanism is applicable when person is selling goods or services to someone. Advanced tax mechanism is applicable in all situations. Advanced tax mechanism is applicable in all situations. In case of TDS and TCS, some other person is deducting or collecting our tax and is paying it to the government on our behalf. Whereas in case of advanced tax, we are paying our own tax to the government. We are paying our own tax to the government directly. Why it is termed as advanced tax? Because it is paid before actually calculating the tax liability and before actually calculating the total income. See, your income is chargeable to tax in the assessment year means your income will be calculated computed and tax liability will be ascertained in the assessment year. Your income will be calculated and tax liability will be ascertained in the assessment year. But this advance tax is payable in the previous year itself on an estimated basis. In costing subject, in certain cases, you used to prepare estimated cost sheet, na? In costing subject, in certain cases, you used to make estimated cost sheet. The estimated cost sheet and actual cost sheet, the format will remain the same. Estimated cost sheet and actual cost sheet, the format, the element of cost, everything is going to remain the same. Estimate means just before actually producing the goods or before actually selling the goods. Actual means at the time of sale or after the sale. This is the only difference. So in this advance tax, na, every SSE has to estimate his tax liability. So he has to make a statement of computation of tax liability on estimated basis. So question is, who is supposed to pay advance tax, by which date he is supposed to pay advance tax, in what circumstances advance tax provisions are attracted, etc. So before we actually move on to discuss this in detail, understand that advance tax is tax paid directly by the SSE to the central government, and this advance tax is paid in 4 installments. In the previous year itself, it is paid in four installments. 15th June of the previous year, 15th September of the previous year, 15th December of the previous year, and 15th March of the previous year. Your previous year is 2021. Your previous year is 2021. So you have to pay advance tax by 15th June 20, 15th September 20, 15th December 20, and 15th March 21. How much advance tax is payable? 15% of advance tax, up to 45% advance tax, up to 75% advance tax, and up to 100% advance tax. Now you may think, what do you mean by advance tax? That we'll discuss. Those SSEs who are covered by section 44 AD and 44 ADA. Do you remember presumptive taxation? Presumptive taxation 44 AD, 44 ADA. Yes, those SSEs are not required to pay advance tax in 4 installments. Even if they pay 100% advance tax by 15th of March, that is okay. Those SSEs will not be required to pay advance tax 100%. Is that very clear? So basically, advance tax is nothing but tax payable by the SSE directly to the government during the previous year itself on an estimated basis. This tax is required to be paid in installments, and there are 4 installments. SSEs, those SSEs who are covered by section 44 AD and ADA, for them it is only 1 installment. For others, there are 4 installments. Now, first of all, tell me, first installment of advance tax is required to be paid by which date? Yes, it is required to be paid by 15th of June. So what will happen on 15th of June now? What will happen on 15th of June? On 15th of June during the previous year, that is 15th June 2020, SSE will estimate his tax liability. SSE will estimate his tax liability. SSE has to do an estimation. Okay. SSC has to do an estimation. On 15th June, can you tell me what period in the year is already over? How much time has already elapsed? If you are standing on 15th June 2020 date, if you are standing on a date 15th June 2020, how much time has already elapsed in the previous year? 2.5 months. 2.5 months are already elapsed. So for those 2.5 months, SSC has to calculate his actual income. Whatever he has actually earned during those 2.5 months, that he has to consider. And from 15th June 20 up to 31st March 21, from 15th June 20 up to 31st March 21, means 9.5 months, SSC has to estimate the income. For 9.5 months, SSC has to estimate the income. So here we have written estimated total income after all available exemption and deduction. But how this estimate will be done? If you are standing on 15th of June, if you are standing on a date 15 June 20, then for 2.5 months, you take the actual income. For 9.5 months, you take the estimated income. On that estimated total income, on that entire income of 12 months, you calculate the tax liability by applying the tax rates. From that, you deduct the rebate if it is available. Add the surcharge if it is applicable. Health and education cess is always applicable. Apply the health and education cess. Once you apply the health and education cess, you will get the amount of tax liability. You will get the amount of tax liability. From this tax liability, you deduct the TDS, you deduct the TCS, you deduct double tax avoidance relief. This is part of CA final. Since I have copied this entire format from my CA final notes, this is also appearing here, so I have not removed. So don't look at this, not relevant at intermediate. You deduct the MAT credit and AMT credit. MAT credit, MAT is chapter, MAT chapter also it is applicable at CA final. AMT chapter we will discuss. Computation of total income tax liability. Now we have covered the concept of AMT because November 2020 ICI had asked a compulsory question on AMT. So from this tax liability, you claim the AMT credit in section 115 JD, you deduct the TDS, you deduct the TCS. Once you deduct all these things, the amount which is arrived will be called as advanced tax liability. All this calculation you are doing for the first time on which date? Yes, all these calculations you are doing first time on which day? We are doing this calculation on 15th of June. These calculations are done on 15th of June 2020. Is that very clear? Okay. Important point to be noted. See here, TDS and TCS they are deducted, na? TDS and TCS they are deducted from your tax liability. So we say that you are claiming TDS and TCS credit. What words we are using in income tax? You are claiming TDS and TCS credit. So the amount of TDS and TCS will be deducted from your tax liability to ascertain the amount of advance tax. So now this important point to be noted says with effect from 1st April 2012, tax deductible or collectible at source, that is TDS and TCS, shall not be reduced here. Shall not be reduced if payer has paid the income without deducting tax at source. Means while paying income to you, payer has forgot to deduct the TDS. In that case, there is no TDS na. then what you will deduct here? You will not deduct anything here. Or the payer responsible to collect the tax at source has received amount or has debited the amount of account of the buyer without collecting tax at source. So if payer has not deducted TDS, if the collector has not collected TCS, then that TDS and TCS amount should not be deducted here. That is logical. That is logical. Only if your TDS is deducted, then only that TDS amount should be deducted here. Only if the TDS is deducted, then only the amount of TDS should be reduced here. Only if the TCS is actually collected, then only the amount of TCS should be reduced here. That is logical. Now this amount which is arrived, final amount, this is called as advance tax liability. Now you listen to me very carefully. If advance tax provisions are applicable to you, then what will happen? If advance tax provisions are applicable to you, then you have to pay advance tax in 4 installments. If advance tax provisions are applicable to you, then you have to pay advance tax in 4 installments. And what if the advance tax provisions are not applicable to you? Then you will not pay advance tax in 4 installments. Then you can pay the tax at the time of filing your income tax return, and that will be called as self-assessment tax. If advance tax provisions are not applicable to you, then you need not pay advance tax. You can pay the tax directly to the government at the time of filing your income tax return, and that will be termed as self-assessment tax. So now the question arises. When the advance tax provisions will be applicable. When the advance tax provisions will be applicable. So point number 1 says advance tax is to be paid on an estimated total income. Point number 1 says advance tax is required to be paid on a estimated total income and it is payable by every SSC. Every SSC has to pay advance tax. Point number 2 says advance tax is payable only if the advance tax liability is 10,000 or more. So if this amount of advance tax liability is either 10,000 or more than 10,000, then only you have to pay advance tax in installments. If this amount is less than 10,000, in other words, this amount is up to 9,999 rupees, then you need not pay advance tax. Then you need not pay advance tax. Advance tax provision will not be applicable in your case. In that case, you can directly pay the tax at the time of filing your income tax return, and that will be called as what? Self-assessment tax. That will be called as self-assessment tax. Have you understood this much? Yes or no? Yes. So advance tax provisions are applicable only if the advance tax liability is 10,000 or more. If the advance tax liability is less than 10,000, then advance tax provisions are not applicable. Very important. I'm giving you one statement, and I'll also be giving you one exception to the statement. The statement is advance tax provisions are applicable only if the advance tax liability is 10,000 or more. Advance tax provisions are applicable only if the advance tax liability is 10,000 or more. Now I'm telling you that even if advance tax liability is 10,000 or more, even if advance tax liability is 10,000 or more, advance tax provisions are not applicable if the SSC is a resident senior citizen and he is not having business profession income. If SSC is a resident senior citizen and he is not having any income from business profession. Deva madam, tax is actually not paid in the assessment year. In the assessment year, only the income is ascertained and tax liability is ascertained. The actual tax is not paid in the assessment year, it is paid in the previous year itself. You can pay the tax in the assessment year at the time of filing your income tax return only if your tax liability is less than 10,000 rupees. If your advance tax liability is 10,000 or more, then you have to pay the tax in the previous year itself. Who told you that you pay tax in the assessment year? Where it is written? Where you have read this? If you have read it in the chapter of basic concept, section 4, charging section of income tax act, it doesn't say tax is payable in the assessment year. It says income will be chargeable to tax in the assessment year. Income will be chargeable to tax in the assessment year means income will be ascertained. Tax liability will be ascertained. Ascertaining means to quantifying the income and quantifying the tax liability. So, actual tax payment doesn't happen in the assessment year, it happens in the previous year itself. Actual tax payment doesn't happen in the actual tax is not paid in the assessment year, it is paid in the previous year itself. Only in one circumstance, only in one situation you can pay the tax in the assessment year. That is when your advance tax liabilities, not one circumstance, two circumstances. Two circumstances you can pay the tax in the assessment year. Circumstance 1, when your advance tax liability is less than 10,000 rupees. And circumstance 2, you are a resident senior citizen not having business profession income. Only in these two cases you pay the tax in the assessment year. Otherwise, you have to pay tax in the previous year itself. So please don't misunderstand the provisions. Provisions, no, they are never saying that tax is payable in the assessment year. Tax, it is payable in the previous year itself. So advance tax provisions are not applicable in two situations. In two situations or two circumstances, advance tax provisions are not applicable. Which are those circumstance situations? Number 1, advance tax liabilities less than 10,000. Advance tax liabilities less than 10,000, then the advance tax provisions will not be applicable. Advance tax provisions are not applicable, then you are not required to pay any advance tax. You are not required to pay any advance tax. You can pay the tax at the time of filing income tax return, and that will be termed as self-assessment tax. Another situation is if you are a resident senior citizen and you are not having any business profession income. If you are a resident senior citizen, you are not having any income from business or profession. In that case, advance tax provisions are not applicable to you. You need not pay any advance tax. You can pay tax at the time of filing return, called as self-assessment tax. Is that very, very clear? Yes? Okay. So point number 1, 2, 3, 4. 1, 2, 3 is over. Point 4, you have to pay advance tax within the due date. Where are the due dates given? Due dates and the amount you are required to pay as advance tax, they are given in section 211. How much advance tax you have to pay? On 15th June, you will do this calculation. On 15th June, you will do this calculation. While calculating your estimated total income, you will take the income, you will take the actual income for 2.5 months, April, May, and 15 days of June. You will take the actual income for 2.5 months. You will take the estimated income for 9.5 months. Then you will get the total income. On that total income, you will calculate the tax liability. From that, you will deduct the rebate, surcharge, etc. Add the health and education cess, if applicable. Then you deduct TDS, TCS, MAT credit, AMT credit, balance is your advance tax liability. If this amount is 10,000 or more, then advance tax provisions are applicable to you. how much amount of advance tax you are supposed to pay? This advance tax amount now, of this you have to pay 15% by 15th of June. You have to pay up to 15% of this amount by 15th of June. Thereafter, once again you have to do such calculation on 15th of September. Once again you have to do similar calculation on 15th of September. 15th of September, you will take the actual income of 5.5 months. 1st April to 15th September, 5.5 months will take the actual income. From 15th September to 30th March, that is 6.5 months. You will take the estimated income. As in when you proceed further, as in when you go ahead, your actual income will increase and estimated income will reduce. So while paying the on 15th of June, while we paid the first installment of advance tax, we took the actual income of 2.5 months, estimated income of 9.5 months. While paying the second installment of advance tax on 15th of September, we'll be taking up actual income for 5.5 months and estimated income for 6.5 months. So on 15th of September, you have to take actual income for 5.5 months, estimated income for 6.5 months. You will get the income for 12 months. On that 12 months income, you estimate the tax liability, deduct the rebate, add the surcharge, add the health and education cess, claim the MAT and AMT credit, deduct TDS, TCS, etc. The balance amount is called as advance tax liability. On that amount, you apply 45%. On 15 September, you will apply how much? You will apply 45%. By applying 45%, whatever amount you are getting now, by applying 45%, whatever amount you are getting, by applying 45%, whatever amount you are getting, from that amount, you deduct the amount which you already paid on 15th of June, because this percentage of 45% is cumulative in nature. This 45 will definitely include this 15%. This 75 will definitely include this 45%. This 100 will definitely include the 75%. So these are cumulative percentages. So when you do the calculation on 15th of September, whatever advance tax liability you have arrived at on 15th of September, on that you apply 45%. Whatever amount you arrive, you get by applying the 45%. From that you deduct what? Amount paid in earlier installments. You deduct amount paid in earlier installments and balance tax you have to pay right now. That is on which day? 15th of September. Have you understood? Yes or no? Okay. Once again, you have to do the similar calculation. Same statement, similar calculation. Once again, you have to do which date? 15th of December. When you are on 15th of December, you will take actual income for how many months? You will take actual income for 8.5 months. And you will take estimated income for 3.5 months. Up to 15 December, na, third installment of advance tax is required to be paid by 15 December. So from 1st April to 15 December, it is 8.5 months. For those 8.5 months, you will take the actual income. For the remaining 3.5 months from 15 December to 30th March, you will take the estimated income. You take the actual income, you take the estimated income, you take the total of both. You take the actual income, you take the estimated income, you take the total of both. You will get the amount of total income. On that, calculate the tax liability, deduct rebate, add surcharge, add cess, claim the credit for MAT, TDS, TCS, etc. The balance is advance tax liability. On that, you apply 75%. by applying 75% whatever amount is arrived. From that, you deduct whatever advance tax you have paid in first installment as well as second installment. You deduct whatever advance tax you have paid in first installment and second installment. And the balance tax you have to pay in third installment. Yes. So same procedure you have to follow. Every 3 months you have to follow the same procedure. The only change is while you do the advance tax liability calculation for every succeeding installment, your actual period will increase and the estimated period will reduce. Last time you will do this calculation on which date? 15th of March. While you do the calculation on 15th of March, your income, your actual income will be taken for how many months? 11.5 months. And you have to estimate your income only for 15 days. So you, on 15th of March, you take the actual income of 11.5 months. You take the estimated income for 15 days. You get the total income. On that, you calculate the tax liability. From that, you deduct rebate, add surcharge, add cess, claim the MAT credit, deduct TDS, TCS. The balance is nothing but advance tax liability. You have to take 100% of that amount. 100% of that amount means same amount will get. From that, you deduct whatever is being already paid in first, second, and third installment. From this amount, whatever advance tax liability you calculate on 15th of March, 100% of tax you take. You take 100% amount. From that, you deduct whatever is being already paid in first, second, and third installment. Whatever balance is left, you should pay on 15th of March. Have you understood this? Yes or no? Yes. Important points to be noted. SSE covered by section 44 AD and ADA shall pay 100% advance tax by 15th March, even if SSE is having other income. See, this relaxation is offered to the small SSEs. To small SSEs, relaxation is offered. 44 ADA, 44 ADA. SSE is covered by section 44 AD and SSE is covered by section 44 ADA. They can pay this amount. They can pay the 100% advance tax by 15th of March. Even though they are having some other income like capital gain, IFOs, etc. Let them pay the advance tax in one installment only, that is by 15th of March. And they have to pay 100% advance tax by 15th of March. Any tax paid after 15th March up to 31st March will also be considered as advance tax only. So, see, you have to pay 100% advance tax by 15th of March. But because of some problem, if you could not pay 100% advance tax by 15th of March, then even if you pay by 31st of March, we will consider this as advance tax only. But yes, we will levy interest for 1 month. You have to pay 100% advance tax by 15th of March. You did not pay 100% advance tax by 15th of March. In that case, even if you pay the advance tax by 31st of March, that amount will also be considered as advance tax. But yes, you have to pay interest for 1 month. For 1 month, you will be required to pay the interest. So tax paid after 15th March, but up to 31st March shall also be treated as advance tax only. If SSE fails to pay advance tax, if SSE fails to pay advance tax, SSE will be considered as SSE in default. whatever advance tax he has paid. Section 219 says we will give him the credit of the advance tax. We will give him the credit of the advance tax. See, in the assessment year on 31st July or 31st October, whichever date is applicable to him, he has to file his income tax return. While he is filing his income tax return, at that point of time, there will not be any estimated income. There will be only actual income. On that actual income, he will calculate the actual tax liability. From that actual tax liability, he will deduct TDS. He will also deduct TCS. He will also deduct advance tax. And thereafter, if something is left, he will pay that tax at the time of filing the income tax return. And that tax will be termed as self-assessment tax. That tax will be termed as what? It will be termed as self-assessment tax. Have you understood this? Yes or no? Shall we proceed? See, whatever procedure I have explained you now for calculation of tax, etc., that is written here. Only for your reference. I don't think that this will be asked in the examination. Only for your better understanding we have written. And this is copied from ICI module, 100% copy it is. Computation and payment advance tax. SSE has to estimate his current income. SSE has to estimate his current tax income. Sarvana is asking me the question, sir, what if long-term capital gain arises to the SSE? Long-term capital gain arises to the SSE in the month of December, say on 31st December, 10 lakhs of long-term capital gain has arisen to the SSE. Then that he cannot estimate, na? See, you cannot estimate your capital gain, you cannot estimate your winning from lottery, etc. It is not possible for you to estimate certain incomes like winning from lottery, crossword puzzle, card game, gambling, betting. Those income cannot be estimated. Capital gain also cannot be estimated. So government says if capital gain has arisen on 31st of December, then by 31st December you might have already paid first, second, and third installment of advance tax. In that you might not have considered any capital gain only. So now you consider, now do you believe that there is any balance installment left? Yes. The fourth one, which is required to be paid on 15th of March. Then you take into account capital gain while you calculate the advance tax liability on 15th of March. Is that very clear? Salary income can be estimated, house property income can be estimated. Salary and house property income can be very precisely estimated with lot of accuracy. PGBP income can be estimated because a business organization would generally make the budget, etc. So he can also estimate his PGBP income. It is not impossible to estimate the PGBP income. But in that your estimate may slightly go wrong. Capital gain not possible to estimate. Income from other sources you can estimate, but in income from other sources you cannot estimate the winning from lottery, etc. So two things are difficult to estimate. Not two things, three things. Number one, capital gain, nearly impossible to estimate. Number two, winning from lottery, etc. Not nearly, it is really impossible to estimate. And if you have started income for the first time in your life, if you have started business, if you have started earning income for the first time in your life, and that too through business profession, then it is very difficult to estimate your business income or income from profession. So if you are doing business profession for the first time, it is the first year you doing the business or profession. In that case, it is difficult to estimate. So in that case, government has given you relaxation. Government will not levy the interest. If the estimates go wrong, then government will not charge you the penal interest. Yes, is that very clear? Akash is asking me a question, sir. If he pays the tax after 30th March, but before the due date, he have to pay interest. Yes. Yes, Akash. If SSC pays tax after 31st March, but before the due date of filing income tax return, definitely he has to pay interest. He has to pay interest in section 234B. Once we complete this advanced tax provisions, we'll move on to those provisions only. 234A, 234B, and 234C. Now let us move on to this computation and payment of advance tax. Computation and payment of advance tax. Definitely advance tax provisions are applicable only if advance tax liability is 10,000 or more. Even if advance tax liability is 10,000 or more, in that case also advance tax provision will not apply to you if you are a resident senior citizen not having business income. If you are a resident senior citizen not having business profession income, in that case, even if the advance tax liability is 10,000 or more, advance tax provisions are not applicable to you. That goes without saying. Yes, shall we proceed? Okay. Computation and payment of advance tax. SSC has to estimate his current year income. For paying the advance tax, SSC has to estimate his current year's income. Number two, he has to pay advance tax on his own accord. What do you mean by he has to pay advance tax on his own accord? Means we are not going to call him up just 5 days before 15th June. The first installment of advance tax is due. Have you paid? No, please pay. We are not going to call you up. We are not going to put you a reminder. You have to remember the dates and you have to remember the provisions. If the advance tax provisions are applicable to you, pay the advance tax. Government will not send you a reminder for paying the advance tax. No, government doesn't have that much time also. So you have to pay advance tax on your own. No one is going to remind you. AO can serve the order on the SSC to pay the advance tax. If SSC feels that my advance tax liability is less than 10,000, I need not pay advance tax. But the income tax officer feels that no, his advance tax liability is 10,000 or more. Then in that case, income tax officer can serve you an order to pay the advance tax. Why he feels so now? In that order, he will also give you the reason. Because of following reasons, we believe that your advance tax liability will be 10,000 or more. So kindly pay the advance tax. This advance tax is required to be calculated either based on assessed income or returned income, whichever is higher. See, if you yourself are calculating the advance tax now, you have to estimate your total income and estimate the tax liability. On that estimated tax liability, you calculate advance tax. From that estimated tax liability, you deduct TDS, TCS, etc., and you will get the amount of advance tax. But if as income tax officer is sending you the order for paying advance tax, then how he will calculate advance tax now? He will calculate advance tax based on the income of past years. He will see that last year you had a lot of income. So he will safely presume that those income will prevail in the current year as well. So he will take the income numbers of the last year, wherever those incomes are of regular nature, like income from salary, income from house property, bank interest, FD interest, those income are of regular nature. So income tax officer will take the income of the last year. He will take either assessed income or returned income. Returned income means income declared by the SSC in his income tax return. Returned income means what? Income declared by the SSC in his income tax return is called as returned income. And what do you mean by assessed income? Assessed income means income which is ascertained by the income tax department. Income which is ascertained by the income tax department. That is called as assessed income. So the income tax officer will calculate your advance tax based on assessed income or returned income, whichever is higher. Assessed income or returned income, whichever is higher. Yes, is that very clear? What is the time period for serving this order to the SSC to pay the advance tax? At any time during the financial year, but not later than February. Not later than last date of February. Income tax officer cannot send you the notice in the month of March saying that please pay the advance tax, because anyway the year has ended. Point 6. Assessing officer can amend the order for payment of advance tax based on latest assessed or returned income. If assessment is done for the latest year, then SSC can change the order, amend the order based on the latest estimates, based on the latest returned income or assessed income. SSC can file his estimate of income and advance tax calculation. If you feel that income tax department is asking you to pay more advance tax, then you can file your estimate of total income and advance tax calculation with the officer. If SSC's estimation is higher, then SSC has to follow his estimate and pay the advance tax. Deduct the TDS from the tax liability. Agricultural income shall be taken into account for the purpose of calculation of tax liability. Partial integration scheme is applicable. Then you have to calculate the advance tax also by partial integration scheme. Point number 11 says, if you have paid less advance tax in first installment, you can pay more advance tax in second installment to compensate the deficit of the first installment. If you have paid more advance tax in first installment, then you can pay less advance tax in second installment. Whatever surplus was paid in the first installment will be compensated, will be adjusted against the second installment. So every succeeding installment you can increase or decrease depending upon whether you have paid less advance tax in the past months, in past installment, or whether you have paid more advance tax in past installments. Now this is rule number 119A. Actually this rule is not applicable only in this chapter, it is applicable everywhere. This is called as rounding of rules. Do you remember in the basic concept chapter we had discussed the rules with respect to rounding of section 288A and section 288B? Total income as well as final tax liability should be rounded up to nearest multiple of 10 rupees. Anything which is after point, that is decimal, should be totally ignored. And if the last digit is 5 or more, it should be rounded up to next multiple of 10 rupees. If it is less than 5, it should be rounded up to previous multiple of 10 rupees. Yes. Similarly, we have rounding of rules for interest amount also. We have the rounding of rules. See point number A. First of all, rule number 119 is applicable when in calculation of interest payable by the SSC or interest payable by the central government. When you pay interest to the government or government is paying interest to you, in both cases these rules of rounding off are applicable. See, rounding off can be either rounding, it can be rounding up or it can be rounding down. For example, your income is 15,55,558. Then that 558 will be considered as 560. So when you go to the next number, it is called as rounding up, and when you go to the previous number, it is called as rounding down. Do you understand? Yes, rounding up and rounding down. One step forward will be called as rounding up. One step backward will be called as rounding down. And both are called as rounding off. So this rounding off can be either rounding down or it can be rounding up. Rounding down the period when the interest is calculated on per annum, interest is calculated on an annual basis. Wherever in the Income Tax Act, wherever in the Income Tax Act, interest rate is given per annum, na? Interest rate is given per annum. In that case, the period for which interest is required to be calculated, that period should be rounded down. For example, in a particular provision, government says interest is payable at the rate of 12% per annum. So that rate of interest is on an annual basis. Then the period should be rounded down. Period should be rounded down. If it is a period of 5.5 months, you should take 5 months only. Part of the month should be totally ignored. You should take only rounded month. That is rounded down month, 5 months. Have you understood this? Yes or no? Okay. But if the rate of interest given in the provision is not an annual rate of interest, there is a monthly rate of interest. See, for delay in deducting tax, for delay in paying TDS, the rates of interest are given now 1% per month or part of the month, 1.5% per month or part of the month. That 1% per month or part of the month and 1.5% per month or part of the month. That is not an annual rate. That is a monthly rate of interest. In that case, the period for which you have to calculate the interest should be rounded up. Should be rounded up. That is the reason I told you now. 1% per month or part of the month. So if it is 5.5 months, if it is 5.5 months, it will be considered as 6 months. 6 months, 1 day will be considered as 7 months. So you have to do rounding up. You have to round up the period when interest is calculated on monthly basis. Fraction of the month will be considered as full month. Have you understood this very clearly? Yes. Point number A. Can you tell me point number A and B is talking about? Karina. Ja. Point number A and point number B. Point number A and point number B. They are talking about what? Are they talking about rounding of the amount? Are they talking about rounding of the rate of interest? What they are talking about? Yes. Point number A and point number B, they are talking about what? They are neither talking about rounding of the amount, nor they are talking about the rounding of the rate of interest. They are talking about the rounding of the period. They are talking about rounding of the period. Is that very, very clear? Point C. Point C, rounding down the amount. The point A and B was rounding of the period. Point number C is rounding down the amount on which interest will be calculated. That rounding down should be done to the nearest multiple of 100 rupees for the purpose of calculating interest. Say for example, the amount of tax which you have not paid is 15,580 rupees. On that interest will be levied. But for the purpose of levying interest, this 15,580 rupees should be rounded up to 100. It will not be rounded up, it will always be rounded down. So 15,580 will become 15,500. Have you understood this? This amount is required, the amount on which interest is required to be calculated, that amount is required to be rounded down to the nearest multiple of 100 rupees. Even though the total income and tax liability is rounded up to the nearest multiple of 10 rupees, this is rounded down to the nearest multiple of 100 rupees. So with this, our rounding off rules are also over. Now in this chapter, we are left with only interest calculation under section 234A, B and C. Actually 234A, I have taken in the next chapter, that is assessment procedure. So we are left with, we'll do only two sections here, 234B and 234C. Only two sections will be discussed. So now in this chapter, our discussion is pending with respect to calculation of interest. Which interest? Interest in 234B, 234C. And on this, we have one practical question, that is question number 10. That question number 10 also we will solve. Yes. So two sections are yet to be discussed, 234B and 234C, and question number 10 is required to be solved. Yes, shall we proceed? 234B. We'll complete 234B, 234C, and if possible, we'll try to complete the question also. And then we'll have a break and start a new chapter. Then we'll have a break and then start the new chapter. 234B. See, first of all, please understand that this is interest payable to the government. So you need to understand, number one, what is the nature of default? What default you have committed that government is asking you to pay interest? That you have to understand. So number one, you have to understand the nature of default. If you have committed that default, then yes, you have to pay interest. If it is certain that yes, you have to pay interest because you have committed a default, then for calculating interest, you need three things. For calculating interest, you need three things. Number one, rate of interest. Number two, the amount on which this interest is required to be computed. And number three, period for which interest is required to be computed. Amount on which interest is required to be computed and period for which interest is required to be computed. If you don't have these three information, rate of interest, amount on which interest is required to be calculated, and period for which interest is required to be calculated, if you don't have these three information, then you cannot calculate the interest. It is impossible. Yes or no? Now listen to me carefully. Before we actually move on to discuss this, before we actually move on to discuss interest under section 234B and interest under section 234C, I need to explain you certain terms. I need to explain you certain terms. Number one term, first term is returned income. What is the first term? Returned income. What do you mean by returned income? Returned income means the income which is declared by the SSC in his income tax return. Say for example, you are declaring an income of 10 lakh rupees in your income tax return. Then that 10 lakhs will be called as returned income. So returned income is the income declared by the SSC in his income tax return. Are you getting my voice? Yes or no? Huh. First term was what? First term was returned income. What do you mean by returned income? Returned income means the income which is declared by the SSE in his income tax return. I took an example saying that SSE is declaring an income of 10 lakh. SSE is declaring an income of 10 lakhs in his income tax return. Then 10 lakhs will be called as returned income. That 10 lakhs will be called as what? It will be called as returned income. Next is assessed income. Assessed income means income which is ascertained by the income tax department. Income which is assessed by the income tax department. Income tax department might have calculated your income. In filing your income tax return, you have declared an income of 10 lakh. But income tax department says, according to our calculation, your income is 12 lakhs. Then 12 lakhs will be called as assessed income. 12 lakhs will be called as assessed income. Assessed income means amount of income which is assessed by the income tax department. So, first of all, have you understood these two terms very clearly? Returned income and assessed income. Okay. Now, in our example, 10 lakhs is returned income and 12 lakhs is assessed income. 10 lakhs is what? 10 lakhs is returned income and 12 lakhs is assessed income. Tax on 10 lakhs. Tax on this 10 lakhs will be called as tax on returned income. Tax on 10 lakhs will be called as tax on returned income, and tax on 12 lakhs will be called as tax on assessed income. Tax on 10 lakhs will be called as tax on returned income. Tax on 12 lakhs will be called as tax on assessed income. Here I have given you what is the, how do you calculate the tax on returned income and how do you calculate the tax on assessed income. That is defined here. I am giving you 30 seconds time. Refer this very quickly. Only 30 seconds time. Yes. Have you referred this? What do you mean by tax on returned income? Tax on returned income means tax on total income declared by the SSE in his income tax return minus TDS minus TCS minus relief, if any, under section 89(1). Do you understand this relief? I discussed this relief with you in the chapter of income from salary. Relief in case of advance salary, arrears of salary, etc. Minus the MAT credit, minus the AMT credit, minus the DTAA relief. So, you have to calculate tax on your returned income. In our example, returned income was 10 lakhs. So, you calculate tax on 10 lakhs. From that, you deduct TDS, TCS, relief under section 89(1). You deduct MAT credit, AMT credit, and DTAA relief. Thereafter, whatever amount is left, that will be called as tax on returned income. Then we have tax on assessed income. Then you have tax on assessed income. Assessed income means income assessed by the income tax department. Income tax department will ascertain your income either in section 143(1) or 143(3) or 143(1) or 144. This section will be forming part of your CA final assessment procedure chapter. Right now you forget about that. Right now you just understand that this is tax on assessed income. Assessed income means the income which is determined by the income tax department. In our example, Assessed income was how much? 12 lakhs. So on that 12 lakh, you calculate the tax. From that, you deduct advance tax, you deduct TDS, TCS, relief under section 81, MAT credit, AMT credit, DTAA relief. All these things you have to deduct. Have you understood what is the amount of tax on assessed income and what is the amount of tax on returned income? Okay. Now say for example, in your examination, question is not giving you assessed income. Question has not mentioned any assessed income. In that case, assessed income will be considered to be same as returned income. For the examination purposes, if the question is not giving you any assessed income, then assessed income will be considered to be same as returned income. Assessed income will be considered to be same as returned income. So point number 3 we have written, if the question is silent, then for question solving purposes, assessed income and returned income shall be assumed to be same. Assessed income and returned income shall be assumed to be same. Have you understood this very clearly? Let us proceed further now. We'll move on to section 234B. First of all, we'll understand what is the nature of default which you have committed. And once you have understood the nature of default, then we can proceed to understand the calculation of interest on that default. So 234B, what is the nature of default? What default you have committed? 234B is a default in payment of advance tax. 234B is a interest for default in payment of advance tax. 234B is nothing but interest for defaulting payment of advance tax. When can we say that there is a default in payment of advance tax? When can we say that there is a default in payment of advance tax? Number one, SSE has failed to pay advance tax. Number one, SSE has failed to pay advance tax. Means he has not paid advance tax at all. SEC has not paid the advance tax at all. Or advance tax actually paid is less than 90% of the assessed tax. Either he has not paid advance tax at all, or advance tax which he has paid is less than 90% of the assessed tax. So whatever amount you were supposed to pay as advance tax, you have actually paid less than 90% of that same amount. For example, your advance tax liability is 1 lakh rupees, and you have to pay advance tax in 4 installments. If I take up the total of whatever you have paid in all the 4 installments, if that amount turns out to be less than 90,000, then in that case we say that advance tax actually paid is less than 90% of the assessed tax. Advance tax actually paid is less than 90% of the assessed tax. Have you understood this? So 234B is interest for default in payment of advance tax. In 2 circumstances, we can say that there is a default. Number one, SSE has failed to pay advance tax. And number 2, advance tax actually paid by the SSE is less than 90% of the assessed tax. In that case, interest will be levied at the rate of 1% per month or part of the month. Interest will be levied on what? Interest will be levied at what rate? At the rate of 1% per month or part of the month. Here, part of the month will be considered as full month. Here part of the month will be considered as full month. That I have already discussed with you in rule number 119A. Rounding up the period when interest is calculated on monthly basis. When interest is calculated on monthly basis, you have to round up the period. So here the interest rate is given per month. So you have to round up the period means go to the next month. Round down the period means go to the previous month. So rate of interest is 1% per month or part of the month. This interest is required to be calculated on what? This interest is required to be calculated on tax on assessed income. This interest is required to be calculated on tax on assessed income. See, in these important points, in point number 1, I had explained you what is tax on assessed income. So on this amount, on the amount of tax on assessed income, you have to calculate interest under section 234B. So you have understood the rate of interest to be applied. You have understood the amount on which this interest is required to be calculated. And now you need to understand the period for which this interest is required to be calculated. This period for which you are required to be calculate the interest will start from first day of the assessment year. This period will start from which date? First day of the assessment year. This period will start from first day of the assessment year, and this period will end on the date on which income tax department has assessed your income. This period will end on the date on which income tax department has assessed your income. Say for example, you have filed your income tax return on 31st July. In your case, the due date for filing income tax return is 31st July. You have filed your income tax return on 31st July. By 31st July. But income tax department has assessed your income only on 31st December. Income tax department has assessed your income only on 31st December. In that case, you have to calculate interest from 1st April to 31st December. You have to calculate interest from 1st April to 31st December. Have you understood section 234B? Yes or no? Yes. Okay. So now let us move on to section 234C. Let me ask you one question before we actually move on to section 234C. Let me ask you a very simple question. My question to you is, say for example, my advance tax liability is 10,000 or more. My advance tax liability is 10,000 or more. So definitely I need to pay advance tax. Say for example, my advance tax liability is 1 lakh. So I have to pay advance tax, that is certain. But for example, on 15th June, I did not pay anything. On 15th September, I did not pay anything. On 15th December, I did not pay anything. I have not paid any advance tax in first 3 installments. But the entire amount of advance tax I have paid on 15th March. Entire amount of advance tax I have paid on 15th of March. Do you believe I will have to pay interest in 234B? Will 234B apply? B will not apply. Why? My advance tax liability was 1 lakh, and entire 1 lakh I have paid on 15 March. So 234B cannot apply. Are you understanding? If 234B is not applicable, then definitely what people will do? Everyone will pay 100% advance tax by 15 March. Then what is the point of government making the rule saying that you should pay advance tax in 4 installments? So if you don't pay anything in first, second, and third installment, and you pay the entire amount in fourth installment, in that case, section 234B will not apply. Which section will apply? 234C will apply. What is section 234C? It is interest for deferment of advance tax. It is interest for deferment of advance tax. You have paid advance tax. You have paid the advance tax, but whatever was required to be paid in the month of June, you have paid in the month of March. Whatever was required to be paid by 15th of September, you have paid on 15th of March. Whatever is required to be paid on 15th of December, that also you have paid on 15th of March. Means you have paid advance tax entirely in 15th March, means you have delayed, you have postponed the payment of advance tax. You have delayed or you have postponed the payment of advance tax. In that case, section 234C interest will be applicable. Section 234C interest will be made applicable. Section 234C interest. It is interest for deferment of advance tax. SSE fails to pay prescribed percentage of advance tax, then 234C will apply. SSE has paid the advance tax, but he has paid something less than the prescribed percentage. What is the prescribed percentage? 15%, 45%, 75%, and 100%. By 15th June, 15th September, 15th December, and 15th March respectively. In that case, interest will be levied at the rate of 1% per month or part of the month. Interest will be levied on what? On the shortfall in the installment. On the shortfall in the installment. Whatever first installment you were supposed to pay, and whatever first installment you have actually paid, difference will be calculated. How much you were required to pay in the first installment and how much you have actually paid up to first installment. Then how much you have actually paid up to second installment and how much you have actually required to pay up to second installment. This comparison will be done. And shortfall will be ascertained. This shortfall will be ascertained based on which income? Based on returned income. 234B interest is calculated based on tax on assessed income. 234C interest is calculated based on tax on returned income. In our example, returned income was 10 lakhs. Assessed income was 12 lakhs. So tax on 10 lakhs will be called as tax on returned income. Tax on 12 lakhs will be called as tax on assessed income. So 234B needs to be calculated on the amount of tax on assessed income, whereas 234C needs to be calculated on the amount of tax on returned income. Interest will be required to be paid for what period? Interest will be required to be paid for what period? If there is a shortfall in the first installment, shortfall in the second installment, shortfall in the third installment, then interest is required to be paid for 3 months. If there is a shortfall in the first, second, third installment, interest is required to be paid for 3 months. If there is a shortfall in the fourth installment, if there is a shortfall in the fourth installment, then interest is required to be paid only for 1 month. Then interest is required to be paid only for 1 month. Why only for 1 month? Because fourth installment is required to be paid by 15th of March. If you have not paid the advance tax by 15th March, definitely you will pay by 31st March. So 15th March to 31st March, only 15 days, na? That 15 days will be considered as 1 month, and we will levy interest for 1 month. What if you have not paid by 31st of March? Then anyway 234B interest will apply from the first day of the next assessment year. Section 234B interest is applicable from the first day of the assessment year, yes or no? 234B interest is applicable from the first day of the assessment year. 234C interest will be calculated up to last day of the previous year. Your auditing subject is over. Auditing subject. Yes. So in auditing, you might have heard, na? In auditing, you might have heard, when accounting ends, auditing starts. When accounting ends, auditing starts. Similarly here, we can say when 234C ends, 234B starts. When 234C interest ends, 234B interest will start. In other words, section 234B and section 234C, they are mutually exclusive sections. They are mutually exclusive section means for the same period, 234B and C will not be levied. Up to the end of the previous year, 234C will be levied. From the first day of the assessment year, 234B will be levied. Have you understood this very clearly? Now, I want to explain you 2-3 important points. But for explaining you those 2-3 important points, I want to ask you a very simple question. 234C interest is levied on what amount? 234C interest is levied on what amount? It is levied on shortfall. Sarvana, not only last installment, all installments. 234C interest will be levied on the amount of shortfall. Shortfall in the first, second, third, and fourth, all installments. Why there can be a shortfall? Yes. Why there is a shortfall? How much installment you are supposed to pay and how much installment you have actually paid. There is a shortfall. There will be a shortfall when you are paid less as compared to what you are supposed to pay. There will be a shortfall when you have actually paid less as compared to what you were required to pay. But my question is, why the shortfall will arise? Shortfall can arise because of what reasons? That is the question. So number one, shortfall will arise because of wrong estimation of your income. Every 3 months you have to estimate your income. To pay the advance tax installment, you have to estimate your income. If you estimate your income wrongly, you underestimated your income, whereas your actual income is much more. While doing the estimate, you underestimated your income. Your actual income is much more. In that case, we will say that there is a shortfall. There is a shortfall. Is that very, very clear? Shortfall can arise in first installment also, second installment also, third installment also, fourth installment also. Shortfall can arise in all the installments. Why shortfall will arise? Because of number one, estimating your income wrongly. You have underestimated your income. and government says, if you have wrongly estimated your income, you have underestimated your income because of certain things. It is not possible to estimate your every income correctly, na? I already told you, it is not possible to estimate capital gains. It is impossible to estimate winning from lottery, crossword puzzle, etc. It is impossible to estimate your business income if you have started the business for the first time. So in these cases, na, you might underestimate your income and your actual income might be much more. So in this case, there might be a shortfall. On that shortfall, interest will not be levied. If there is a shortfall in the payment of advance tax installment, because of what? Because of underestimation or failure to estimate, number one, capital gain. Because of failure to estimate your winning from lottery, crossword puzzle, races including horse race, card game, any other income in the nature of gambling, betting, etc. Or there is a failure to estimate income under that PGBP if the income has arisen for the first time. So you are paid less advance tax. You are paid less advance tax because there is a failure to estimate. There is a failure to estimate because it is impossible to estimate your capital gain. It is not possible to estimate the winning income. It is not possible to estimate your business income if you are doing business for the first time in your life. In that case, government says we will not levy 234C interest. Government says we will not levy 234C interest provided the month in which these incomes have actually arisen. Thereafter, if some advance tax installment is due, then tax on this capital gain winnings should be paid as part of those installments. For example, capital gain has arisen in the month of January. In your case, capital gain has arisen in the month of January. By January, you might have already paid 3 installments now, 15 June, 15 September, and 15 December. While estimating your income for those 3 installments, you might not have taken into account capital gains because capital gain has actually arisen only in the month of January. So government says there is a wrong estimation for first, second, and third installment. We will not levy interest on the shortfall because shortfall is due to capital gains. We will not levy interest provided condition is, do you believe that after the month of January, there is some advance tax installment due? Yes. Which installment? 4th installment. Which date? 15th of March. 15th of March. So entire tax of the capital gain, entire capital gain tax should be paid by 15th of March. While you pay the last installment of advance tax 15th of March, entire tax on capital gain should be paid. If the entire tax on the amount of capital gain is paid on 15th of March, that is balance installment. Then on shortfall in case of first, second, and third installment, interest will not be levied. Have you understood this? Dixit, yes, first day of the assessment year means 1st April 21 only. But the important point which we are discussing right now, they are applicable to 234C only, not for 234B. Yes? Have you understood this? If there is a underestimation or failure to estimate capital gain winning and failure to estimate business income, if the business income has arisen for the first time and SSE has paid the amount of tax in respect of such income as part of remaining installment of advance tax, and where no such installments are due by 31st March of the financial year, then no interest will be levied under section 234C. For example, capital gain has arisen to you on 17th March. So by 17th March, you have already paid all the 4 installment of advance tax. So no advance tax installment is due after 17th March. In that case, you pay tax on capital gain by 31st of March. If you pay tax on capital gain by 31st of March, we will not levy interest under section 234C. Have you clearly understood this? Yes or no? Shall I proceed? Let's move on to the last point. Before actually we move on to this last point, second point, let me ask you a very simple question. You have to pay advance tax in 4 installments, right? You have to pay advance tax in 4 installments. So 4 times in a year, 4 times in a year, you have to estimate your total income. My question to you is, when it is difficult to estimate? It is difficult to estimate on for 15th June, 15th September, 15th December or 15th March. When it will be difficult for you to estimate your income? Sarvana, how 15th March? Sarvana, on 15th March, you will already have actual income of 11.5 months. You have to estimate your income only for 15 days. But while you pay the first installment of advance tax, you have the actual income of only 2.5 months. And you have to estimate your income for 9.5 months. So my question is, when it is difficult for you to estimate your total income and tax liability? Definitely it is difficult to estimate at the beginning of the year. As and when you move on up to the end of the year, it is not difficult to estimate because your actual income will be more. Actual income will be for a higher period. Estimated income will be for a very short span of time. For example, 15th of December. The 15th of December, already 8.5 months you'll be having actual income. So you have to just estimate for 3.5 months. 15th of March, you are already having actual income for 11.5 months. So you have to just estimate your income for 15 days. So government says it is not a very big challenge to estimate your income for 15 days or estimate your income for 3.5 months. But yes, first installment and second installment. First installment, your actual income is only for 2.5 months. You have to estimate your income for 10.5 months. Estimating income for 10.5 months is slightly difficult. It is challenging. There are chances of error. There are chances of underestimation. Similarly, second installment, you will have the actual income for 5.5 months and you have to estimate the income for 6.5 months. Here also, there is a challenge. You may underestimate your income. So government says, we are giving relaxation to all SSEs. We are giving relaxation to all SSEs in case of first installment and second installment. How much installment is required to be paid? How much percentage of advance tax is required to be paid in first and second installment? 15% and 45%. 15% and 45%. But government says, even if you have paid only up to 12%, you have paid 12% or more, but less than 15. How much advance tax you have paid in first installment? You have paid 12% or more, but less than 15. In that case, we will not levy any interest to you in section 234C for the shortfall in the first installment. Similarly, if you have paid at least 36% amount, you have paid 36% or more, but less than 45%, then also we will not levy interest on shortfall in case of second installment. Have you understood this? In other words, let me ask you question in other language. What if you have paid the first installment only 10% advance tax? Yes, in first installment you have paid only 10% advance tax. Will government levy 234C interest? Definitely yes. On the difference of what? Difference of 10 and 12 or difference of 10 and 15? Difference of not 10 and 12, not 12 and 15. Difference of 10 and 15. For example, I do not know whether these things were part of your state board examination or not. In school days, we used to get grace marks. In school days, we used to get grace marks. Passing marks was how much? If you want to pass the examination, and an examination is being conducted for 100 marks, out of 100 marks, how much is passing mark? In school days, not now. In school, right now in C exam it is 40 marks. In school days it was 35, na? It was not 30 or it was 35. In school days, passing marks were 35. But you know now, if you have scored anything 30 or anything more than 30, if you have scored 30 or more, then we will give you grace marks and we will pass you. Yes or no? Did you have the grace mark concept in your school? If you have scored 30 or more marks, say for example, you have scored 32 marks, no grace marks. Passing marks are 30. Here in Maharashtra State Board, we have grace mark system. Now it is not existing. Earlier it was existing. If you have scored 30 marks now, then 5 marks will be given to you as grace mark and we will pass you and we'll send you to the next standard. If you have scored 32 marks, you are short by 3 marks. We'll give you a grace mark of we'll give you 3 marks as grace and we will pass you and we'll send you to the next standard. What if you have scored only 29 marks, then what? Will we give you grace of 6 marks? No. Grace marks will be given only if you have scored 30 or above than 30. Only if you have scored 30 or more, then only grace marks will be given. Now say for example, a student has scored 29 marks. Will he get grace marks? Definitely not. Definitely no, he will not get any grace marks. So he has passed or he has failed. Definitely he has failed. So he has to repeat the same standard once again. He has to stay in that same standard for 1 more year. Now my question to you is, the student has scored 29 marks. So definitely he has failed. He has failed because of how many marks? What is the shortfall? Is it only 1 mark or it is 6 marks? Shortfall is not 1 mark, it is 6 marks. Passing marks were 35, student has scored only 29, so there is a shortfall of 6. Similarly, here you were supposed to pay 15% was tax, but government says we will give you relaxation. Even if you pay 12% or more but less than 15, we will not penalize you, we will not levy interest. But you have actually paid only 10%. You are required to pay 15%. We gave you some relaxation, but you paid less than that also. You paid only 10. So there is a shortfall. How much shortfall? Yes. If you have paid less, if you have paid 10% advance tax, can we say that shortfall is difference of 10% and 12%, that is 2%? No. Shortfall is 5%, difference of 10 and 15. Yes or no? Have you all understood this? Similarly, in second installment, government has given a relaxation. You are actually required to pay 45% advance tax. But government says, even if you pay 36% or more, you pay 36% or more, less than 45%, we will not levy 234C interest. But what if you have paid only 30%? Then how much is the shortfall? If you have paid only 30% advance tax by 15 September, then the shortfall is difference between 30 and 45. If you have paid only 30% advance tax by 15th of September, then the shortfall will be difference of 30 and 45, that is 15. Have you all understood this very clearly? Yes. So we have completed this section 234B and C interest discussion. I think we'll have a break and then only we'll discuss question number 10. So we'll move on to a practical question. That is question number 10. Read this carefully. What it says: a company having a total income of 50 lakhs filed its return of income for the assessment year 21-22 on 11th November 21. See, in case of company, books of accounts are required to be audited. In their case, due date of filing return will be 31st of October. As per budget 2020 amendment, due date of filing income tax return in their case will be 31st of October. They have filed return on 11th November. It has paid the advance tax as below: 15 June, 15 December, 15 September, 15 December, 15 March. 2 lakh, 3 lakh, 5 lakh and 1 lakh. If you have observed, these amounts are not cumulative. These are the actual amount paid on the respective dates. But we need the cumulative amounts. Cumulative amounts means 15%, 45%, 75%, 100%. Those percentages are cumulative. So for calculating interest under section 234C, amounts should also be cumulative. Since cumulative amounts are not given to us in the question, we can ascertain. So just next to this column, you can write against 15th June, you can write 2 lakhs. Against 15th September, against 15th September, how much will write? 2 plus 3, 5 lakhs. Against 15 December, how much will write? 2 plus 3 plus 5, 10 lakhs. Against 15 March, how much will write? 2 plus 3 plus 5 plus 1, 11 lakhs. So these amounts have now become cumulative. 2 lakh, 5 lakh, 10 lakh, 11 lakhs. These amounts have now become cumulative. For the purpose of calculation of interest under section 234C, at 15%, 45%, 75%, 100%, those are cumulative percentages. So we need to do the comparison on a cumulative basis only. TDS credit available is 1 lakh. TDS credit available is 1 lakh. Find out the interest payable under section 234B and C. First of all, tell me what is the advance tax liability in this case. This is the company. Say for example, the tax rate is 30%. So what will be their basic tax liability? 50 lakh into 30% will be 15 lakhs. Yes or no? In case of company, their income is taxable at flat rate of 30%. If the turnover does not exceed 400 crores, then 25%. If the turnover exceeds 400 crores, which turnover? turnover 2 years back. Right now it is previous year 2021. So we have to look at the turnover of 1819. If the turnover of 1819 is less than or equal to 400 crores, then what? If the turnover of 1819 is less than or equal to 400 crores, then the tax rate will be 25%, otherwise 30%. So that turnover is not given to us in the question. So we will be taking 30%. So 50 lakhs is the total income. 50 lakhs is the total income. On that you calculate tax at 30%. That be 1515 lakhs. Yes or no? Will surcharge be applicable? Yes. In case of company, surcharge is applicable only when income is more than 1 crore. So in this case, income is not exceeding 1 crore. So no surcharge. Cess is applicable? Yes, cess is always applicable. So calculate 4% cess on the tax liability of 15 lakhs. 15 lakh into 4% is 60,000. So tax liability is 15 lakh 60,000. Tax liability is 15 lakhs 60,000. Is that very clear? ₹15 lakh 60,000 is the tax liability. Now from that you deduct TDS credit. What is the TDS credit? 1 lakh. No TCS credit. So what is the balance amount? 14 lakh 60. This 14 lakh 60,000 is advance tax liability. How much you have actually paid? 2 plus 3 plus 5 plus 11. So you have actually paid 2 plus 3 plus 5 plus 1 is 11. So you actually paid 11 lakhs. Whether you have paid more than 90% or less than 90%. Take out the 90% amount of 14 lakh 60. What is the 90% amount of 1460? So what is the 90% amount? 13 lakh 14,000. 13 lakh 14,000. Is it 13 lakh 14,000 or is it 13 lakh 14,500? So by mistake I have written here 13 lakh 14,500. If it is 13 lakh 14,000, make this as 13 lakh 14,000. On page number 356. Make it 13 lakh 14,500. Sorry, 13 lakh 14,000. So make it 13 lakh 14,000. Now have you paid 13 lakh for more than 13 lakh 14,000? No. You have paid only 11 lakh rupees. You have not paid more than 13 lakh 14,000. You have paid less than that. You have paid only 11 lakhs. So can you tell me what is the shortfall then? For calculating the shortfall, you should not compare 11 lakh with 13 lakh 14,000. You should compare 11 lakh with 14 lakh 60,000. So what is the shortfall? Yes. Are you understanding the calculation? Yes or no? Yes. So tell me what is the shortfall? Your advance tax liability is 14 lakh 60,000, but you have actually paid only 11 lakhs. So there is a shortfall of 3 lakh 60. On this 3 lakh 60, can I say you have paid advance tax less than 90% advance tax payable? Advance tax actually paid by you is less than 90% advance tax payable. So in that case, what will happen? In that case, you have to pay interest on shortfall. Interest at what rate? 1% per month or part of the month. From which date to which date? From the first day of the assessment year till the date on which you file your income tax return, till the date on which your income is assessed by the department. Now, date on which income is assessed is not given. So you should calculate interest up to the date on which the income tax return is filed by the assessor. The date of assessment is not given. Assessed income is also not given. Assessed tax is also not given. So we are doing the calculation based on tax on returned income. Yes or no? So 234B interest we should take from first day of the assessment year, that is 1st April 21 up to 11th November 21. 1st April 21 to 11th November 21 is how many months? 8 months. For 8 months you pay interest at the rate of 1% per month. For 8 months it is 8%. So what is the amount of 8% on 360? Yes. Sarvana, first day of the assessment year. Section 234B interest is from first day of the assessment year till you file your income tax return. Na? Actually, it is up to the date on which the assessment is done by the department, but that date is not given to us. So we should take the interest up to date on which the return is filed, that is 11th November. So from 1st April to 11th November, it is how many months? 7 months and few days. That will be taken as 8 months. So you have to pay interest at the rate of 1% for 1 month. For 8 months, it will be 8%. So 8% on what? On the amount of shortfall. What is the amount of shortfall? 14 lakh 60 minus 11 lakh. That is 3 lakh 60. Yes or no? So 3 lakh 60 into 8% will give you 28,800. 28,800. Yes, have you clearly understood this? Okay. Now let us proceed further to calculate interest under section 234C. For 234C, we have to ascertain how much amount was payable installment wise. What is the advance tax liability? 14 lakh 60,000. 14 lakh 60,000 is the advance tax liability. Advance tax is required to be paid on 15 June, 15 September, 15 December and 15 March. How much is required to be paid? 15%, 45%, 75%, 100%. Of what? Of advance tax liability. What is the advance tax liability? 1560 minus 1 lakh TDS credit 1460. So tell me what is 15% of 14 lakh 60? 15% of 14 lakh 60 is how much? 2 lakh 19. Then you take 45% of 14 lakh 60. 45% of 14 lakh 60. 657. Then you take 75% of 14 lakh 60. 1095. And the last one is 100% of 14 lakh 60, that is 14 lakh 60. Now tell me how much amount of advance tax is actually paid. First installment 2 lakh was paid. Second installment more 3 lakh was paid. So 2 plus 3, 5. Take the cumulative numbers here. Third installment more 5 lakh was paid. So 5 plus 5, 10 lakhs. Fourth installment 1 lakh was paid. So 10 plus 1 is 11 lakh. Now we have to find out the shortfall. Now we have to find out the shortfall between what is actually paid and what was actually payable. Amount paid is 2 lakhs. Amount payable was 2 lakh 19. But you know that in case of first and second installment, some relaxation is available. Yes or no? Some relaxation is available in case of first and second installment. How much is the relaxation? Up to 12%. So get me 12% of 14 lakh 60. What is 12% of 14 lakh 60? 175 200. So have you actually paid more than 175 200? Yes, you have paid 2 lakhs. So no interest will be levied on a shortfall in case of first installment. The first installment shortfall is taken as 0 because you have paid 12% or more. No shortfall, no interest on first installment. Next, in second installment also relaxation is available. If you pay up to 36% of advance tax, no interest will be levied. Yes. Get me the amount of 36% of 14 lakh 50. 525 600. Have you paid up to 525 600? No, you have paid only 5 lakhs. You have paid only 5 lakhs. So now for ascertaining the shortfall, 525 600 will not be taken into account. 525 600 will not be taken into account for ascertaining the shortfall. 525 600 is just calculated to find out whether you are covered in relaxation or not. Not covered by relaxation, find out the difference between these two. 657 and 5 lakh. The difference is 157. 657 and 5 lakh, the difference is 157. Of that 157, you apply 1% interest for 3 months, that is 3%. So you take out 3% of 1,57,000. 3% of 157 will be how much? 4710. Have you all clearly understood the calculation? This is the interest for shortfall in case of second installment, 4710. Third installment, fourth installment, there is no relaxation. Directly you find out the shortfall. 10 lakh 95 minus 10 lakh is 95,000. On this 95,000, 1% interest for 3 months, that is 3%. So you take out 3% of 95,000, 2850. So this is the interest for shortfall in case of third installment. Then let us calculate the fourth installment shortfall. 1460, 11 lakh, difference is 360. On that 360, you calculate interest at 1% for 1 month. That will be 3,600. Yes or no? Now you just take the total. 4710 plus 2850 plus 3,600. Dikshit, last installment 1 month interest na? Because from the first day of the assessment year, 234B is already levied. 234A and 234B cannot be levied. Both sections cannot be levied for the same period na? When 234C ends, 234B will start. So total amount of interest under section 234C is 11,160. Interest under section 234B was 28,800. So now you give me the total. 28,800 plus 11,160 is 39,960. Yes. So with this we have covered up the entire chapter. Now we are left with 3 chapters. All of them are too small. 15 September. Rizwan, 15 September, You were supposed to pay the advance tax of 6,57,000, but you actually paid only 5 lakhs. But in case of the second installment of 15 September, some relaxation is available. How much is the relaxation? 36%. So you calculate 36% of 14,60,000. 14,60,000 multiplied by 36% will give you 525,600. Have you paid more than 525,600 or you have paid less than 525,600? If you have paid more than 525,600, then we will not levy interest for second installment. But you have paid only 5 lakh, na? Yes or no? So interest will be levied. Now this 525,600, which is 36%, is a relaxation. If you are not covered by the relaxation provision, then interest will be levied on the entire differential amount. 525,600 will not be taken into account for computing the difference. Difference will be taken as difference of 657 and 5 lakh only. 525,600 is only for the purpose of checking whether you are covered by the relaxation provision or not. If you are not covered by relaxation provision, find out the difference between 657 and 5 lakh, that is 157. On that, apply 3%. 1% per month, 3%, 3 months. Yes. So right now it is 10:21. Yes. Dikshit. For the last installment, 15 days are there. So that 15 days should be taken as full month. That is what we discussed in Rule 119A, na? Rule 119A. What we discussed? Rounding up the period when interest is calculated on monthly basis. So there the rate of interest is 1% per month or part of the month. So round up the period. 15 days will be considered as 1 month. Yes. So now we are left with 3 chapters: return of income and self-assessment, computation of total income and tax liability, and income exempt from tax. So what I am doing is, I am taking up the next chapter as income exempt from tax. Income exempt from tax chapter I am taking up page number 370. My target is to complete this chapter today. Income exempt from tax chapter will get completed. Yesterday I had already given you that 2 pages as homework, na? In this chapter we have to learn only one section in detail. That is section 10AA. That's all. This is the most important section. Numerous times examiner has the question. A practical question on this section is tested once in every 3 attempts. Once in every 3 attempts, examiner is asking question on section 10AA. So this is very, very important. Section 10AA gives a tax holiday. Section 10AA is a section relating to exemption. It gives a tax holiday. Government says we are giving a tax holiday for 15 years. You don't pay tax for 15 years. We are giving you a tax holiday. Let us try to understand this. Can you see the word file on the screen? Okay. Now listen to me carefully. We are in section 10AA. What this section 10AA says? Section 10AA says that if you are setting up a business unit in a special economic zone, do you understand special economic zone? Yes or no? No. Yes, special economic zone means SEZ only. Say for example, this is a port. This is a port. And say for example, there are a lot of manufacturers. There are a lot of manufacturers. Can you see the word file? Yes. Now say for example, there are different manufacturers. They are manufacturing goods and they are situated at different places. All of them are situated at different place. And all of them are exporting the goods. So once the goods are manufactured, these people will have to take their goods to the port na, for exporting. Yes or no? So what government has to do now? Government has to provide them infrastructure at all these 4 locations. These 4 manufacturers are situated at 4 different places. These 4 manufacturers are located at 4 different places. So government has to provide them infrastructure at all these places. Government has to ensure that there is a proper 24/7 electricity supply, 24/7 water supply, proper connectivity of roads up to the port, because these people will manufacture the goods and they will carry the goods to the port. So there should be a proper road network na. There should be a proper road connectivity. If there is no road connectivity, how these people will carry the goods na? So government will construct one road from manufacturer 4 to up to the port. up to the port, government will make one road. Thereafter, government has to build one more road for connecting these people. For connecting these people to the port, government has to make one more road. So what government will do? From year to year, they will make one road. Similarly, they will connect manufacturer 2 to the main road. They will also connect manufacturer 3 to this main road. And finally, this main road will be connected to the port. This main road will be connected to the port. See how much amount of money government will be required to spend for providing road infrastructure to them. Government has to connect this road from manufacturer 4 to port, from manufacturer 1 to port, from manufacturer 2 to port, and manufacturer 3 to port. Now, for example, from manufacturer 1 to port, this is the lengthiest route, say 10 kilometers. Then from manufacturer 2 to the main road, it is say 2 kilometers. Manufacturer 3 to the main road, it is say 3 kilometers. So 10 plus 3 plus 2, 15 kilometer road is constructed. And from manufacturer 4 to the port, 10 more kilometer road is constructed. So 25 kilometer of road is constructed. Instead of spending so much amount of money, government came out with an idea saying that government says that we will create one SEZ. We will decide one location. Say for example, location is here. This location we are declaring it as SEZ, Special Economic Zone. We will ask all the manufacturers to set up their factories there only. We will ask all the manufacturers to set up their factory there only. So manufacturers will set up their factory. Where they will set up their factory? This manufacturer will set up their factory in the Special Economic Zone. And that Special Economic Zone will be near to the port. So now government has to construct only this much road. Only this much road government has to construct. So government will declare this area as a Special Economic Zone. This area will be declared as Special Economic Zone. Now government says all those people who want to export the goods can set up their factory in the Special Economic Zone. All those people who want to export the goods, they can set up the factory where? In the Special Economic Zone. All these manufacturers, will set up the unit in this special economic zone. Manufacturer 1, 2, 3, 4, everyone will set up their factory where? They will set up their factory in a special economic zone. Once the goods are manufactured in the special economic zone, they can be easily transported to the port because special economic zone is near to the port. Now government will not have to provide infrastructure facility at 4 different locations. If these all manufacturers are situated at 4 different locations, then at all the 4 locations, government has to provide 24/7 electricity supply, 24/7 water supply, 24/7 banking facility, proper road connectivity up to the port. So government has to incur cost which is very high. They have to incur cost 4 times. At 4 different locations, they have to incur the cost now for constructing road, for providing electricity. Transmission lines will be set up for providing water supply. Water pipelines will be set up. All this will cost heavily to the government. So instead, government came out with an idea saying that this area we are declaring as special economic zone. This area we are declaring as special economic zone. Any person who is setting up his factory inside the special economic zone, we will give him exemption for few years. We will give him a tax holiday. So with the intention to minimize the infrastructure cost, government came out with the concept of special economic zone. And all those manufacturers who are exporting their goods, they will set up the factory in special economic zone. What is the advantage to them for setting up the factory in the special economic zone? They will get a tax holiday for a 15 years period of time. So government says, you set up your manufacturing unit in the special economic zone, we will give you a tax holiday for 15 years. Have you understood this? Yes or no? So government will declare one area as a special economic zone. That area will be developed by someone. The person who is developing that area will be called as SEZ developer. Reliance is the biggest SEZ developer in India. So government will allot the plot of land to them. They will develop the SEZ, means they will construct the lot of land is just given. So they will construct the road, they will construct the factory sheds, etc. And they will sell the factory premises to different manufacturers. If you are one of the manufacturer, you purchase the factory shed in special economic zone and you set up your factory within the special economic zone, you will enjoy tax holiday for 15 years. Yes? Have you understood the purpose of this concept? Okay. So now, what is the advantage of this special economic zone concept? What is the advantage to the manufacturer? We saw what is the advantage to the government. Government has to invest very less money in infrastructure because government has to provide or set up infrastructure facility only at one location instead of 4 different locations. But what is the advantage to the SSC who has set up his manufacturing unit in special economic zone? For him, advantage is what? He is enjoying a tax holiday for 15 years. So this is the advantage to him. Now, how much tax holiday? How to quantify the amount of exemption or deduction under section 10AA? That we will understand here. So business organization, we are dividing the business organization into 2. Business organization is having a manufacturing unit or unit inside the SEZ will be called as a SEZ unit. If the business organization is having a business unit outside the SEZ, that will be called as a SEZ, non-SEZ unit. So unit set up inside SEZ will be called as a SEZ unit. Unit set up outside SEZ will be called as a non-SEZ unit. Goods are manufactured in SEZ as well as non-SEZ unit. Goods are manufactured in both units, SEZ unit as well as non-SEZ unit. Whatever goods are manufactured in SEZ unit, they can be sold either in the domestic market or the international market. These goods which are manufactured can be sold in the domestic market or it can be sold in the international market. If the goods are sold in the domestic market, the value of goods sold will form part of domestic turnover. If the goods are sold in the international market, then the value of goods sold will form part of export turnover. Similarly, those goods which are manufactured in non-SEZ unit, means factory unit set up outside the SEZ area, that will be called as non-SEZ unit. All goods which are manufactured in this non-SEZ unit can also be sold in the domestic market or international market. If they are sold in the domestic market, the value of goods sold will form part of domestic sales or domestic turnover. Goods sold in the export international market will be forming part of your export turnover. Will be forming part of your export turnover. So you can have domestic sales as well as export sales in case of SEZ unit, as well as domestic sales and export sales in case of non-SEZ unit. From these domestic sales and export sales, you will earn some profit. So here we have profit from domestic sales, profit from export sales. Similarly, here also profit from domestic sales of goods manufactured in non-SEZ unit and profit from export sales from goods manufactured in non-SEZ unit. Have you understood this? So the profit is bifurcated in 4 parts. Profit is bifurcated in 4 parts. Part number 1 is profit from a domestic sales of the goods manufactured in SEZ unit. Number 2 is profit from export sales of goods manufactured in SEZ unit. Number 3 is profit from domestic sales of goods manufactured in non-SEZ unit. Similarly, we have profit from export sales from goods manufactured in non-SEZ unit. So this profit we have bifurcated in 4. Profit from domestic sales of SEZ unit, that profit is fully taxable. Profit from domestic sales of non-SEZ unit, that is also fully taxable. Profit from export sales of non-SEZ unit is also fully taxable. So tax holiday, exemption, deduction is available in respect of which profit? Profit earned from export sales of which unit? Of SEZ unit. Profit from export sales of SEZ unit. Whatever goods are manufactured in SEZ unit, out of those goods, whatever goods are exported, out of that whatever profit is earned, that profit is eligible for deduction under section 10AA. First of all, have you understood 10AA benefit is available, tax holiday? Tax holiday is available for which profit? Yes or no? So profit from domestic sale of SEZ unit as well as profit from domestic sale of non-SEZ unit, both are taxable. Profit from export sales of non-SEZ unit is taxable, but profit from export sales of SEZ unit is eligible for deduction under section 10AA. So deduction under section 10AA, 15 years tax holiday is available only in respect of export turnover of SEZ unit. whatever profit you have earned from export turnover of SEZ unit. Now listen to me very carefully. Practically, a business organization would maintain separate books of account for SEZ unit and separate books of account for non-SEZ unit. Business organization would maintain a separate books of account for SEZ unit and separate books of account for non-SEZ unit. So whatever profit he has earned from non-SEZ unit is fully taxable. Whatever profit he has earned from non-SEZ unit is fully taxable. Whatever profit, say for example, SEZ unit domestic turnover is 20 crores and profit is 5 crores. This is fully taxable. SEZ unit export sales is 80 crores and profit on that 80 crores is 20 crores. 20 crores. This 20 crores only is eligible for exemption. This 20 crores tax benefit will be available in section 10(AA). How much tax benefit? Tax holiday is allowed for 15 years. Tax holiday is allowed for 15 years. From year number 1 to year number 5, it is 100% of the profit. Year number 1 to year number 5. Yes. Page number 370. Can you see this? Yes or no? Okay. Deduction for the first 5 years. What do you mean by first 5 years? Year in which you have set up the unit in SEZ, that will be called as year number 1. So 5 years will start from which year? From the year in which you have started manufacturing goods in SEZ unit. So for the first 5 years, 100% of the profit will be allowed as reduction. 100% of the profit. Which profit? Profit from export turnover of SEZ unit. For the next 5 years. First 5 years means year number 1 to year number 5. Next 5 years means year number 6 to year number 10. Year number 6 to year number 10. What will be allowed as reduction? 50% of the profit of export turnover of SEZ unit. Export turnover SEZ unit, not 100% profit, only 50% profit will be allowed as reduction. Only 50% profit will be allowed as reduction. Deduction for next 5 years. Once again, next 5 years means which year? Year next 5 years means year number 11 to year number 15. Year number 11 to year number 15. Deduction allowed will be 50% of profits and gains from 50% of profits and gains from export turnover of SEZ unit compared to amount transferred to special economic zone reinvestment allowance reserve. Amount transferred to special economic zone reinvestment allowance reserve. Have you learned the chapter of amalgamation in accountancy? Amalgamation chapter is over. Yes or no? Amalgamation chapter you might have learned, na? In amalgamation, you might have learned there is something called as statutory reserves. Statutory reserves are compulsorily taken over by the amalgamated company. And the amalgamated company is expected to keep those statutory reserves for some period of time. All those statutory reserves are created under the Income Tax Act. You might have heard about some statutory reserves like investment allowance reserve, development rebate reserve, export profit reserve, foreign project reserve. All these statutory reserves are created under different sections of the Income Tax Act. So here also statutory reserve is created. Here also statutory reserve is created. So here deduction will be available to the extent of 50% of profits and gains of export turnover of SEZ unit, provided equivalent amount is transferred to special economic zone reinvestment allowance reserve account. Provided equivalent amount is transferred to what? Special economic zone reinvestment allowance reserve account. In other words, from year number 1 to year number 10, you get the deduction. From year number 1 to year number 10, you get the deduction without transferring anything to reserve. From year number 1 to year number 10, you get the deduction without transferring anything to reserve. But from year number 11 to 15, from year number 11 to 15, if you want deduction, then you have to transfer some amount to reserve. If you don't transfer to reserve, then no deduction. So your deduction will be lower of following two amounts. Number one, 50% of the profits and gains of the export turnover of SEZ unit and amount transferred to special economic zone reinvestment allowance reserve account. Have you understood this? Yes or no? Okay. So once again, word file is appearing on the screen. This deduction under section 10AA is available only in respect of export turnover of SEZ unit. Year number 1 to 5, 100% profits are deductible. Year number 6 to 10, 50% profits are deductible. Year number 11 to year number 15, 50% of profits are deductible, subject to the condition that equivalent amount of profit is transferred to special economic zone reinvestment allowance reserve account. So deduction under section 10AA will be lower of following two amounts: 50% of the profit of export turnover of SEZ unit and amount transferred to special economic zone reinvestment allowance reserve account. Now let me give you the numbers. For example, export sales of all the 15 years. Every year export sale is 80 crores only. Year number 1 to year number 15, every year export sale is, say for example, 80 crores. And every year profit on that export sale is 20 crores. So what will be your deduction in year number 1? Year number 1 deduction will be 20 crores. Year number 2, 20 crores. Year number 3, 20 crores. Year number 4, 20 crores. Year number 5, 20 crores. Year number 6, 7, 8, 9, 10, 10 crores. Yes or no? Year number 11, 12, 13, 14, 15, 10 crores or amount transferred to special economic zone reinvestment allowance reserve account, whichever is lower. Year number 11 to year number 15, deduction under section 10AA will be lower of following two amounts. Number one, 50% of profit, that is 10 crore, and number two, amount transferred to special economic zone reinvestment allowance reserve account. Yes, have you understood this? So now let us move on to the section. Tax holiday for units established in special economic zone. Tax holiday for units established in special economic zone. Following conditions are required to be satisfied if SSE wants to claim any deduction under section 10AA. Number one, SSE should be entrepreneur as per the SEZ Act 2005. SSE should be entrepreneur as per SEZ Act 2005. Number two, SSE has set up a unit in special economic zone and he has begun manufacturing of goods or providing services from that special economic zone during the assessment year 6-7 to assessment year 2021. So 2021 is the last year. This is assessment year. So don't think that This section is already expired. No, you can set up the unit in 1920, and from 1920 you can claim deduction for 15 years. So now this year onwards, entry into the section is restricted. But people who have already entered the section up to last year only, they can claim deduction for 15 years. Point number 3, SSC has exported goods or he has exported services including computer software out of India from the special economic zone by land, sea, air or any other mode, whether physical or otherwise. Goods will be definitely transferred physically. Services can be provided through air also, internet also. Amount of deduction under section 10AA will be how much? Deduction under section 10AA will be equal to profit of unit in SEZ. Profit of unit in SEZ multiply by export turnover of SEZ unit divided by total turnover of SEZ unit. Whatever is the profit of SEZ unit now, from that you have to calculate proportionate profit of export turnover. So we are just doing the cross multiplication. So profit of unit in SEZ multiply by export turnover of SEZ unit divided by total turnover of SEZ unit. Is that very clear? Yes or no? Yes. Now I will give you 2 minutes time. You kindly refer this. What is the meaning of export turnover? CBTD circular issued in 2018 and this note. Refer these three things and then I'll explain you this. This is very important. 3 marks MCQ was asked last to last examination on this. So refer this very quickly on your own. Then we will have a discussion on this. Okay. So let us start. See here they have given you how to ascertain this export turnover amount. How to ascertain this export turnover. This is the formula which will be used for the purpose of computation of deduction under section 10AA. This formula will be used. Deduction under section 10AA equals to profit of the entire unit of SEZ multiply by export turnover of SEZ unit divided by total turnover of SEZ unit. Now they are saying what things should be included in export turnover and what things should be excluded from export turnover. Everything should be included in export turnover. What things are required to be, everything should be included in export turnover. What is required to be excluded is given in the question. What is required to be excluded from export turnover is given. So export turnover means consideration received in India or brought into India by the SSC in respect of export of goods or services, including computer software. So export doesn't mean that you have just exported the goods. You have to also realize the money. You have to realize the money and you have to bring that money into India. Only that amount will be considered as export turnover. For example, you have exported goods worth 10 crores, but you bought in India only 8 crores. Then only 8 crores will be considered as export turnover. Are you understanding? Yes or no? So if you have exported goods worth 10 crores, but you brought into India only 8 crores, then only 8 crores will be considered as part of export turnover. So bringing money into India is also important. That is also important. Further it says, however, export turnover will not include export. See, when you export goods outside India, you have to deliver the goods now. You have to deliver the goods to the buyer outside India. So you will incur number one freight. You will pay freight to whom? For the shipping. For shipping of goods from India to another country, you will have to pay freight to the shipping company now. Plus you may incur some telecommunication charges, insurance attributable to delivery of goods, transit insurance. While the goods are transported from India to some other country, you may take some transit insurance. So you may incur money for transit insurance. So freight, telecommunication charges, and insurance attributable to delivery of goods outside India or any other expenditure incurred in foreign currency outside India, that should be excluded. From the export turnover also this should be excluded. From the total turnover also this should be excluded. So CBDT has clarified in circular number 4 in the year 2018, dated 14th August 2018, that this freight, telecommunication charges, insurance, and expenditure incurred outside India, all these things are required to be excluded from the export turnover as well as the total turnover. So that is required to be removed from numerator as well as denominator. Export turnover does not include freight, telecom charges, or insurance or expenditure incurred outside India. CBDT has issued the notification and clarified that this freight, telecom charges, and insurance should be excluded both from export turnover as well as total turnover. So they are required to be removed from the numerator as well as from the denominator. On this point, question was asked in the examination. Very important note: profits and gains derived from site development of computer software, including service for development of software outside India, shall be deemed to be profits and gains derived from export turnover. See, in India, we are having a lot of big giant software companies. Sometimes the software company will send the employee on site. On site means at a foreign location. Say, for example, Infosys has taken a contract from a UK-based company for maintenance or development of software. So Infosys will send one of the employee to UK. Even though employee is rendering services in UK, that will be considered as export only, because services are given outside India by the Indian entity. So that will be considered as export of software outside India. That will also be eligible for deduction under section 10AA. Yes, have you understood this? Yes. Okay. Deduction under 10AA is available how much? For the first 5 years, 100% of export profit of SEZ unit. For the next 5 years, that is year number 6 to 10, 50% of profit from export turnover of SEZ unit. For year number 11 to 15, 50% of profits and gains from export turnover of SEZ unit, compared to amount transferred to special economic zone reinvestment allowance reserve. Now the point is, whatever reserve is created during year number 11 to year number 15, year number 11 to year number 15, reserve is created now. Whatever reserve is created, for what purpose that reserve is required to be utilized, and by what time that reserve is required to be utilized, all these points are given here in this paragraph. So these are the provisions with respect to utilization of reserve. Whatever reserve you have created during the period year number 11 to year number 15, that is required to be utilized for a specified purpose. So read this very quickly, 4 points. I can give you maximum 1 minute. Read this very quickly. Yes, okay. So for what purpose this reserve is required to be utilized? This reserve is required to be utilized for the purpose of purchase of new plant and machinery. This reserve should be utilized only for the purpose of purchase of new plant and machinery. Within what time this reserve is required to be utilized? This reserve is required to be utilized within a period of 3 years from the end of the year in which this reserve was created. For example, reserve was created in year number 11. Then 3 years from the end of year number 11 is year number 12, 13 and 14. So reserve created in year number 11 should be utilized up to the end of year number 14. Reserve created in year number 12 should be utilized up to the end of year number 15. Yes, yes, Dikshit. We are talking about the same reserve which was created during the period year number 11 to 15. If you want deduction under section 10AA during year number 11 to 15, then you have to create reserve. That reserve is required to be utilized for purchasing new plant and machinery. That new plant and machinery should be acquired within a period of 3 years from the end of the year in which reserve is created. So reserve created in year number 11 should be utilized for purchasing plant and machinery up to the end of year number 14. Reserve created in year number 12 should be utilized for purchase of plant and machinery up to the end of year number 15. Reserve created in year 13 should be utilized up to the end of year number 16. Reserve created in year 14 should be utilized up to year number 17. Reserve created in year number 15 should be utilized up to the end of year number 18. Is that very clear? Purpose and time limit for utilization of reserve. The above reserve should be utilized for acquiring new plant and machinery, and the time limit is 3 years. 3 years from the end of the year in which reserve is created. For what purpose reserve should be utilized? For purchasing new plant and machinery. It cannot be utilized for any other purposes. If it is utilized for any other purposes, then we will say that it is misutilized. And amount misutilized will become taxable in the year of misutilization. The amount of reserve which is utilized for any other purpose will be considered to be misutilized, and amount misutilized will become taxable in the year of misutilization. Next point says, whatever reserve was created in year number 11 should be utilized for purchasing plant and machinery up to the end of year number 14. So this up to 3 years. What should we do about that reserve? For that 3 years, reserve can be invested in business. By default, reserve will be invested in business, but you cannot distribute dividend out of that reserve, or you cannot remit that money outside India. See, in the language of accountancy, I can say that this is a non-divisible profit. Do you remember redemption of preference shares chapter? In redemption of preference shares, you are creating CRR, na? Capital redemption reserve. That capital redemption reserve is created from which profit? Divisible profit or non-divisible profit? Yes. That Dikshit, that CRR can be used only for issue of bonus shares, that is correct. But while you redeem the preference shares, no? While you redeem the preference shares, you have to either do fresh issue of shares or you have to create CRR. Whatever CRR you will create now, you will create out of which profit? Divisible profit or non-divisible profit? There is the order which is mentioned now for creating CRR, which reserves can be utilized. So that is created from divisible profit. CRR is created from divisible profit, is not created from non-divisible profit. General reserve, reserve fund, dividend equalization reserve, all these are divisible profit. So the special economic zone reinvestment allowance reserve, na, this is a non-divisible profit. This is a non-divisible profit, means from this you cannot declare the dividend. You cannot remit this money outside India. You have to do one thing only. Acquire new plant and machinery, set up that new plant and machinery. Where? Definitely in India. And that new plant and machinery should be acquired within a period of 3 years from the end of the year in which the reserve is created. If reserve is used for any other purpose, it is considered to be misutilized. It will become taxable in the year of misutilization. Time limit for utilizing the reserve is 3 years from the end of the year in which it is created. Other conditions. Other conditions. Yes, only plant and machinery. That too, new plant and machinery, not second hand one. It should be first hand. In additional depreciation also we had similar condition, new plant and machinery. Here also we are having same condition. The plant and machinery should be new. The unit which is set up in special economic zone, that unit should not be set up by splitting up or reconstruction of existing unit. Say for example, you are already having a factory outside the special economic zone. If you are having the factory outside the special economic zone, whatever profit you earn by exporting the goods, those profits are taxable. So what you will try to do? You will try to you will try to transfer your entire factory to the special economic zone. So you will purchase the factory shed in special economic zone. You will uninstall your plant and machinery, furniture, fixture, etc. And you will set up this plant and machinery, furniture, fixture in a unit located in special economic zone. So what you are doing? You are just transferring your old plant and machinery. So we will give you deduction under section 10AA only if you are not restructuring your existing unit. For example, you are doing business in the name of A Limited. Thereafter this section came and on paper you have created one more company, B Limited. So A Limited is selling entire business to B Limited. And then B Limited says that give me deduction in section 10AA. Government says no, deduction will not be allowed because you are not a new entity. You are a restructured entity. Have you understood this? Sarvana, that will discuss in few minutes. Wait for some time. So, if the existing entity is amalgamated or demerged, restructuring has taken place. In that case, we are not going to give you deduction under section 10AA. Plant and machinery which is acquired should be a new plant and machinery. New plant and machinery means first hand plant and machinery. Now, if you want to use old plant and machinery, then old plant and machinery can be used to the extent of 20% of total value of plant and machinery. Second hand plant and machinery is also okay, but only to the extent of 20% of total plant and machinery. Do you remember? Similar condition was also there in section 35ID in the chapter of PGVP. In section 35ID also same condition was there. Yes. Deva madam, even if you set up the new factory, new factory is constructed, section 10AA is available. But 10AA will not be available for amount spent for constructing the factory building. Madam, section 10AA deduction is available for profit earned from export turnover of SEZ and then reserve created during year number 11 to 15 should be used for acquiring new plant and machinery. If you invest that reserve for setting up a building, then you won't get any benefit. You set up a new factory, that is okay. But this reserve should be utilized only for purchase of new plant and machinery. Organization should not be formed by splitting up of existing organization. Yes, Sarvana, section 35D is specified business. Section 35D is specified business only. So if you are restructuring your existing business is restructured with the intention to claim the deduction under section 10AA, then government says don't try to fool us. We are not going to give you any deduction. Why? Because you have just restructured the existing business. You have not created a new entity. You have not created a new business. New plant and machinery should be acquired using the reserve. Old plant and machinery can be taken, but up to 20% of total value of plant and machinery. Imported machinery will be regarded as new machinery only. So if you have imported a second-hand machinery, that will be considered to be a new machinery only. So second-hand machinery which is imported will be considered to be a new machinery only. For claiming deduction under section 10AA, you have to take certificate or a report from a chartered accountant. For 10 years, from year number 1 to year number 10, without creating any reserve, we are giving deduction to you under section 10AA. During these 10 years, we are not going to give you any deduction with respect to depreciation. We will not give you any deduction with respect to depreciation during this first 10 years. But still you will have to calculate depreciation, and the amount of depreciation should be reduced from the value of block. Amount of depreciation should be reduced from the value of block. Point 5 says no double deduction. Means if you are claiming investment based deduction under section 35AD, or you are claiming certain income based deduction in section 80IA, 80IB, then we will not give you any deduction for that profit of SEZ unit in section 10AA. You have to decide whether you want 35AD, 80IE, 80IB or 10AA. That you have to decide. Particulars to be prescribed from the vendor from which you have purchased this new plant and machinery. Name of the vendor, address of the vendor, nature of plant and machinery, date of acquisition, date of installation. All this information is required to be furnished along with the income tax return. You have to utilize that reserve for purchasing new plant and machinery. So you have to provide the name of the vendor from whom you have purchased the plant and machinery, name of vendor, address of vendor, nature of plant and machinery, when it was acquired, when it was installed. All this information is required to be furnished to the government. Then only you can claim deduction under section 10AA. Last three conditions. Listen to me carefully. Say for example, SSC is having 2 units. One unit is located in SEZ, one unit is located outside SEZ. So you know now, profit earned from unit located outside SEZ, that is non-SEZ unit, profit is fully taxable. And whatever unit is situated in SEZ, out of that, profit proportionate to the export turnover can be claimed as section 10AA. Profit proportionate to the domestic turnover is fully taxable. What people started doing now? Intentionally, they did a transaction between a SEZ unit and non-SEZ unit. And they tried to artificially inflate the profit of SEZ unit, meaning thereby goods are transferred either by SEZ to non-SEZ or goods are transferred by non-SEZ to SEZ. Say for example, goods are transferred by SEZ to non-SEZ unit, and intentionally goods are transferred at a higher value. Why? So that profit of SEZ unit will appear to be more now. If you enter into a transaction with SEZ unit and non-SEZ unit, you are entering into a transaction. Transfer of goods and services by SEZ unit to non-SEZ. See, SEZ unit will try to sell the goods to non-SEZ unit intentionally at a higher value. Why? So that the profit of SEZ unit will appear to be higher. If profit of SEZ unit is higher, then deduction under section 10AA will also be higher. So SSE intentionally, by entering into a transaction between SEZ unit and non-SEZ unit, he is intentionally inflating the profit of SEZ unit. Therefore, government inserted point number 1 saying that if the goods are transferred by SEZ unit to non-SEZ unit and the transaction amount does not correspond to the market value, means the value at which the transaction is entered between SEZ and non-SEZ unit now, that value is not reflecting the market price. It is reflecting value which is higher than the market price. In that case, income tax officer, assessing officer, has a right to compute the income of SEZ unit. Income tax officer will compute the profit of SEZ unit and he will compute the deduction under section 10AA. So government is not going to allow you to intentionally inflate the profit of SEZ unit and thereby claim more deduction under section 10AA. Have you understood this? Yes. Yes or no? Okay. Conversion of export processing zone, free trade zone into special economic zone. Say for example, there is a 100% export processing zone. Export processing zone means that zone which government will declare as an export processing zone. So only those people will be situated there who are exporting the goods. In certain cases, government has converted those export processing zones, free trade zones, into special economic zone. So if you are having a manufacturing unit in export processing zone and that export processing zone gets converted into special economic zone, then you will be eligible to claim deduction under section 10AA. For 10 years, you can claim deduction without creating any reserve. But the question is, say for example, you had set up the factory in export processing zone in the financial year 11-12, and that export processing zone got converted into special economic zone with effect from financial year 15-16. Now the point is, you are eligible to claim the deduction for 10 years. 10 years will be counted from 11-12 or 10 years will be counted from 15-16. So government says 10 years will be counted from 11-12. 10 years will be counted from the year in which you have started your business, started manufacturing activity. So 11, 12, 12, 13, 13, 14, 14, 15. That unit was an export processing unit. It was situated in an export processing zone. So no deduction under section 10AA. Thereafter, this export processing zone got converted into special economic zone in 15-16. So from 15-16 onwards, we will get the exemption. You will get the deduction under section 10AA. But the period of 10 years will not be recognized from 15-16, will be recognized from 11-12. Have you understood this very clearly? Yes? Okay. Deduction in case of business restructuring. Say for example, you have set up a manufacturing unit in special economic zone. You have set up a manufacturing unit in a special economic zone. Now you know that for 10 years you are on a tax holiday. You are enjoying a tax holiday for 10 years. You are eligible to get a tax holiday for 10 years. But for example, you claimed a deduction under section 10AA for year number 1, 2, 3, 4. And year number 5, your company got amalgamated with some other company. So in year number 5, there is a business restructuring. There is an amalgamation, demerger, etc. In that case, how the deduction would be available in section 10AA? So government says, in case of amalgamation, demerger, succession, the new entity will be in a position to claim the deduction for unexpired period. So the old entity has already claimed deduction for year number 1, 2, 3, 4. So new entity will claim deduction for year number 5, 6, 7, 8, 9, 10. So in case of business restructuring, deduction will be allowed to the new entity for balance years, including the year of business restructuring. The year in which the business is restructured, from that year onwards, deduction under section 10AA will be allowed only to the new entity. Is that very, very clear? So with this section 10AA is over. Section 10AA is over. Page number 372 and 373 was given to you as part of homework to study. We will move on to practical question. I have 2 practical questions in this chapter, and both these questions are related to section 10AA only. So we move on to page number 374. Practical question. Can you, or you are having the answer also given there. Nathan Aviation Limited is running 2 industrial undertaking. One unit is in SEZ, that is unit S, and another unit is in normal area, non-SEZ, that is unit N. The brief summarized detail for the year ended 31 March 21 is given below. Unit S as well as unit N. Domestic turnover is given to you, export turnover is given to you, gross profit is given, expenses and depreciation is given, and profit of the unit is given. Can you tell me what will be the treatment of this profit of unit N? 4 crores, sorry, 4 lakhs. This is in lakhs. This 4 lakhs, what is the treatment? Yes, this 4 lakh is taxable because this is a profit from non-SEZ unit. This is fully taxable. And you have 13 lakh profit from SEZ unit. Entire 13 lakh will not be exempted. Profit proportionate to the export turnover will be exempt. What is the total turnover of unit S? 10 lakh plus 120 lakh, total is 130 lakhs. Total turnover of unit S is 130 lakhs. And what is the profit derived from this 130 lakhs? Is 13 lakhs. So can you get me what is the proportionate profit of export turnover? Definitely 12 lakhs. This 12 lakhs will be allowed as deduction, provided this previous year 2021 falls in the first 5 years, because deduction of 100% is allowed only from year number 1 to 5. Year number 6 to 10, 50% deduction. Year number 11 to 15, 50% deduction, subject to the condition that you create reserve for the equivalent amount. So if question is silent, we will take an assumption that yes, this previous year 2021 is falling within first 5 years. So how much deduction will be allowed? 12 lakh deduction will be allowed. So can you tell me what is the amount of profit which is taxable? For unit S, 1 lakh profit is taxable. For unit N, 4 lakh profit is taxable. So what is total taxable? 5 lakhs. Total taxable is 5 lakhs. Yes or no? Now the question further says the brought forward business loss pertaining to unit N is 2 lakhs. So this brought forward business loss now will be allowed to be set off. This brought forward business loss will be allowed to be set off. What is the taxable profit? Taxable profit is 1 lakh from unit S, 4 lakh from unit N, total 5 lakhs. Out of 5 lakhs, 2 lakhs loss will be set off. 2 lakhs loss will be set off against the profit of 5 lakhs. So what is the balance profit then? Only 3 lakhs. Balance profit is only 3 lakhs. So it says briefly compute the business income of the asset. So what is the business income? Business income is 5 lakhs. Set off the loss to the extent of 2 lakhs. Balance is 3 lakhs. Assume that financial year 2021 falls within a period of first 5 years period commencing from the year of manufacture of or production of any article of thing or for provision of services by the units. So that they have clearly given in the question saying that financial year 2021 is falling into first 5 years. Means the deduction is 100%. See this. Total profit is 17 lakhs. Out of 17 lakhs, deduction is allowed for 12 lakhs. So the balance profit is 5 lakhs. Brought forward loss is 2 lakhs. So the final taxable profit is 3 lakhs. And this is the amount of 12 lakh which is calculated by applying this formula. Profit of unit in special economic zone. What is the profit of unit in special economic zone? 13 lakhs. Multiply by in the numerator export turnover 120 lakhs. Divided by total turnover in the denominator 130 lakhs. So 13 lakhs into 120 divided by 130 will give you 12 lakhs. This is the amount of deduction in section 10 double. Yes, have you understood this? Let's move on to question number 2. Question number 2. Rudra Limited has 1 unit at special economic zone and other unit in domestic tariff area. The company provides the following details for the year 2020-21. Company provides the following details for the year 2021. See, now examiner knows that this provision is very simple. Easily you can calculate and give the answer. So he is trying to confuse you unnecessarily. He has given you total sales, export sales, and net profit. Total sales is given for which unit? Entire company Rudra Limited. And this is 6 crores. And unit located in domestic tariff area, total sales is 2 crores. So can you tell me what is the total sales of SEZ unit? Sarvana, it is not 6 crores. 6 crores is the total sale of SEZ unit plus the domestic tariff area. So this 6 crore includes 2 crores as the total sales of domestic tariff area. So how much will be total sales of SEZ unit? It will be 6 minus 2, 4 crores. This is the point wherein examiner has intentionally tried to create the confusion. Otherwise, there is nothing challenging here. So what you can do in your textbook, next to this unit in DTA, you create one more column. Next to this unit in DTA, you create one more column. Here you create one more column. Give the heading SEZ unit. You create one more column and give the heading SEZ unit. In that column, against total sales, how much you will write? 4 crores. 4 crores. Against export sales, how much you will write? 3 crores. 4.6 minus 1.6, 3 crores. What is the net profit? 60 lakhs. Have you understood this? So the total sales, export sales, net profit of SEZ unit is not given directly in the question. You have to ascertain. So here we have done the working note. Total sales of Rudra Limited entire company is 6 crores. Total sales of domestic tariff area is 2 crores. So total sales of SEZ unit will be 4 crores. Export sales of Rudra Limited is 4.6 crores. Export sales from unit located in domestic tariff area is 1.6 crores. So export sales from SEZ unit is 3 crores. Net profit of entire company Rudra Limited is 80 lakhs, of which profit earned from unit located in domestic tariff area is 20 lakhs. So profit from SEZ unit is 60 lakhs. Now can you get me the amount of profit from export turnover of SEZ unit? Yes. How will get that? What is the total profit? 60 lakhs. That should be multiplied by export sales, export turnover 3 crores divided by total turnover 4 crores. So your profit from export sales of SEZ unit will be 45 lakhs. Correct? Now the point is how much will be exempt, how much will be allowed the deduction out of this 45 lakhs? That is the question. Refer to this. They are asking you to calculate the eligible deduction under section 10AA of the Income Tax Act 1961 for the assessment year 21-22 in the following situations. So they are giving you two different situations. What is the first situation? If both the units were set up and started manufacturing goods on 22nd May 2013. If the units have started manufacturing goods on 22nd May 2013, then we are calculating income for 2021. So 2021 is which year? You will start getting deduction from 13-14. So 13-14, 14-15, 15-16, 16-17, 17-18, 18-19, 19-20, 20-21. 2021 is 8th year. It is 8th year. So how much deduction will be allowed? 50% of the profits of export turnover of SEZ unit. What was the profit of export turnover of SEZ unit? You calculated now 45 lakhs. 50% of that 45 lakhs will be 22.5 lakhs. So your deduction under section 10AA will be 22.5 lakhs. Have you understood this? Yes or no? Very good. Now let's move to second situation. Second situation says if both the units were set up and start manufacturing goods from 14 May 2017. 14 May 17 falls in which year? 17-18. And right now you are in 2021. So 17-18, 18-19, 19-20, 20-21. That is fourth year. So deduction will be 100%, correct? So 45 lakhs will be allowed to as deduction. 45 lakhs will be allowed to as deduction. Have you understood this very clearly? So this question is also over. Now we are left with small sections. Section 14A is interesting and important, but not at intermediate level. This is not important at intermediate level, but still it is all, since it is forming part of the module, I have also taken this in my note. I had given you page number 372 and 373 as part of homework. So we'll quickly refer to this other exemption. There is nothing much to discuss in this section. These are small sections. Number 1, share of income received by member from HUF. See, HUF is a separate entity in income tax. Whatever income HUF has earned, on that HUF will have to pay the tax. On that HUF will have to pay the tax. After paying the tax, whatever profit is there now, that profit HUF will distribute to the members. After paying the tax, whatever is the profit now, that profit will be distributed to the members of HUF. The profit which is distributed to the members of HUF, for the member it is called as share of income received by member from HUF. For the member it is called as what? Share of income received from HUF. This share of income will not become taxable in the hands of member. Why? To prevent double taxation. To prevent double taxation, we say that share of income received by the member from HUF is not taxable. Similarly, partnership firm has earned the profit. Partnership firm has paid the tax. Profit after tax is apportioned between the partners. Once again, tax will not be levied in the hands of partner. In the hands of partner, once again, tax will not be levied. This is with the intention to prevent the double taxation. So share of profit received by the partner from the partnership firm is also not taxable in the hands of partner. Point number 3. A non-resident person can open a non-resident external bank account after taking permission from RBI. As per Foreign Exchange Act, you have to take permission from RBI, Foreign Exchange Management Act 1999. According to this, you have to take permission from RBI and you can open a non-resident external bank account. So if a non-resident person has opened a non-resident external bank account after taking permission from RBI, then whatever money is lying in the account of that non-resident person in non-resident external bank account, on that some amount of interest might be earned. On that some amount of interest might be earned. That interest is totally exempt from tax in section 10 clause 4. That interest is totally exempt from tax in section 10 clause 4. Next is point number 4. Remuneration received by officials of embassies of foreign state. Do you recollect section 9? Income deemed to accrue or arise in India. In that we had discussed one point. Salary paid by government of India to government employee rendering services outside India is deemed to accrue or arise in India. It is taxable in India. Allowances and perquisites provided to such an employee outside India will be exempt from tax. See, if government of India is paying salary to government employee in, say, government employee working in Indian embassy in USA, and then we are saying that that salary is deemed to accrue as in India, we will levy the tax. Don't you think in that case the US government will also ask for the same benefit now? So in India, in Mumbai, we have a US embassy. In Mumbai, you have a US embassy. In that US embassy, the officers which are working, they are the employee of US government. So who will pay remuneration to them? US government will pay the remuneration. Who will levy tax? US government will levy the tax. We will not levy tax. Therefore, we have created the section relating to exemption. Remuneration received for services rendered in India as an employee of foreign enterprise. Sorry, as an employee of foreign government. As an employee of foreign government. You are working with a embassy in India. You are working as a employee of a foreign government. Then whatever remuneration you have received from that government, we will not levy the tax. It will be exempted. It will be exempted provided two conditions are fulfilled. Condition number one, remuneration received by our corresponding government official is also exempt in that country. In other words, we are saying that officer of Indian government working in Indian embassy in USA, US government should not levy tax. US government should not levy tax on the income of our officer. We will also not levy tax on the income of officer of US government. So it is both ways. Point B says above mentioned officials should be the subject of respective countries represented and should not be engaged in any other business, profession or employment. Means employee or officer of US embassy in India, his remuneration income will not be taxable, will be exempted provided that person is not engaged in any business or profession or employment in India other than acting as a representative of a foreign government. Have you understood this? Yes. Okay, next is point number 5. Remuneration received for services rendered in India as an employee of foreign enterprise. Foreign enterprise means foreign business organization. Foreign enterprise means foreign business organization. Say for example, Mr. X is a foreign national working with some foreign company, but he has been posted in India. So he is rendering some services in India. He is an employee of foreign enterprise, foreign company. He is posted in India, so he is rendering services in India. That income will not be taxable, provided certain conditions are fulfilled. So remuneration received by foreign national is an employee of foreign enterprise for services rendered by him during his stay in India will be exempt from tax. Say for example, Microsoft and Facebook, they have set up their offices in India and their business is managed by Indian people. But above that Indian people, the officer which is working to monitor all the activities is the employee of foreign company. Whatever remuneration is earned by that employee who is rendering services in India as an employee of foreign enterprise, whatever service is provided by individual in India, that income will not be taxed in India. provided that foreign enterprise is not engaged in any business in India. Provided that foreign enterprise is not engaged in any business in India. Number two, employees' salary in India does not exceed, employees stay in India does not exceed 90 days. Employees stay in India does not exceed 90 days, and employee does not have any other income other than salary. Means he is having only remuneration income from foreign enterprise. And this remuneration is not liable to be deducted from employer's income chargeable under the Act. If employer's income is chargeable under the Act, the remuneration paid to employee should not be deductible in that income. If these three conditions are fulfilled, then what will happen? Remuneration earned by individual from a foreign enterprise will not be taxable. Have you understood this very clearly? Thank you. Bye bye, everyone.